Welcome to the European Market Open, everyone. A minute to go until the start of cash equity trading. I'm Francine Lacqua here in London, and here are your top stories. The IMF raises its global economic outlook for the first time in a year as resilient U.S. spending and China's reopening fueled demand. France unexpectedly grows in the fourth quarter. GDP rose 0.1%, boosted by investment and net trade. We turn our attention to the euro area figures at 11 a.m. And UBS fourth quarter profit soars. The Swiss lender announces a $5 billion share buyback, which the chief executive, Ralph Hammer, says proves it has, quote, the right strategy. So let's look at the futures. A lot going on as markets prepare for key central bank decisions a little bit later this week. Eurostock futures, they're opening momentarily, I think in about 2 seconds, so we can have the countdown together, down 0.2%. Again, investors really positioning for interest rate hikes this week from the Federal Reserve, but also the European Central Bank. I've seen many analyst notes saying that the European Central Bank is probably the one that's most interesting given the amount of news that's coming out of data this week. Also, the sell-off in Adani Group shares are continuing. I think if you look at the 10 companies that make up the conglomerate, they lost some $75 billion in market value that was erased in the last week. So European markets are opening, still a bit of pressure. Again, they're looking at earnings across the board. We had about 3 to 4 European banks here in Europe that beat expectations. We also have UniCredit with a buyback. So we'll look at the European banks. And then, of course, we always look at commodities and, of course, what's happening in the UK. We have a pretty incredible story by Bloomberg Economics looking at the cost of Brexit, and it's about £100 billion. This is a picture for cross assets. So we look at treasuries. We also look at some of the commodities that are on the move. So NASDAQ futures, you can see flat. European stocks also pretty much flat. The U.S. 10-year yield, 35161, as we try and figure out what will happen and what Jay Powell will say. A bit of breaking news on the Norwegian Sovereign Wealth Fund annual performance. I think it's just coming now as we speak. This is an extremely interesting story. Because this is the sovereign wealth fund that's been really trying to stay away from, for example, some of the oil-rich investments that it had in the past. So the fund lost some 14.1% in 2022, under a lot of pressure of finding the right bonds also that they want to be involved in. We had a great conversation. Our Lisa Bravitt spoke to the chief executive of that huge sovereign wealth fund. Let's get over now to our Bloomberg MLive managing editor, Mark Cudmore. And Mark, good morning. Welcome to London. You're looking at NASDAQ.
Yes, good morning, Fran. I've arrived here in London. It's such an exciting week for markets. There's so much going on. And everyone's asking me, what's the Fed going to do? What's the ECB going to do? What's the Bank of England going to do? What's the narrative? Which one's most exciting? My head is full of raclette and fondue. I've got no idea. I'm avoiding all these tough questions and instead going to point at something entirely different. And that is the price action out there is not good. Hang Seng is trading negatively. Crypto has given back some of its gains. I'm looking at the NASDAQ, one of the big tech stocks really suffering last year. Yesterday, for the NASDAQ 100, was the worst day in more than 5 weeks. And in fact, it came at quite a critical time. It came just as the index last week had made its highest close since the middle of September. It really looked like it was breaking out of that range. It had been stuck in it a few months. We were trading that positive story of immaculate disinflation, a wonderful Goldilocks world, and now it's being rejected. Now, you could excuse this negative price action as just being month end. That might indeed be the case. But if you get another poor day today, and then you go into the Wednesday to Friday catalyst, I think this might give us a couple of weeks of negative price action. I'm not yet sure, though, not just the fondue, not just the raclette, I'm not yet sure whether all those central banks do give us a clear macro narrative after the end of this week.
Are we having fondue in London?
Which?
Are we having fondue in London, or are we going skiing?
Well, I wish we could have fondue in London. I must admit, though, I'm slightly fondued out.
Oh, there you go. Bloomberg, MLive, managing editor, never fondued out. Mark Hudmer, always on top of our stocks. Now, the International Monetary Fund has raised its global economic growth outlook for the first time in a year, but has warned that inflation remains a big challenge for policymakers worldwide. Well, Hannah Smith, Vice President for State Street's ETF business, joins us now. Hannah, thank you so much for being with us. I mean, this is a big day because we look at Brexit. Our Bloomberg Economics also calculated the cost of Brexit. We look at IMF, feeling a little bit better about the world economy. Can we avoid a recession in the U.S.?
Well, I think if we look at the IMF and the results that the predictions that we saw coming out, the UK was really the only economy where they predicted it was likely to go into recession. And obviously the cost of Brexit, as well as the tighter labour market, is clearly a concern for the UK economy. But I think, as you mentioned, for the other economies, it does seem to be more positive. Particularly China seemed to be a sweet spot given the opening after the move away from the zero COVID policy and the outlook there. So mixed, but cautiously optimistic, I would say.
Hannah, when you look at markets today, I mean, they're kind of on tenterhooks, and it's very difficult to see what or how to price in what Jay Powell could do. Is this the biggest unknown, or do you think ECB could crop up with surprises?
Yeah, I think the Fed is definitely one to watch, and I think it's likely the market is predicting, and we're predicting a 25 basis point hike there. But I think the focus is really going to be on the wording around that, and what we're anticipating is it's likely he's going to indicate ongoing increases or the opportunity or leave the door open for ongoing increases. So I think that's key in terms of the market not getting carried away with itself, and still, there's still a focus of the central banks in terms of having to be nimble in their approach.
Is the market getting carried away overall? I mean, they seem to have latched on also to earnings and saying, look, earnings were not as bad as expected. Let's go, let's rally.
Yes, I think if we look at January, it definitely feels like it did get a bit carried away. If we look at the ETF space, we saw 20% of all flows that we saw in 2022 just within that 1 month in January. So it's a huge amount of flows that we saw going in. We saw heavy flows into emerging markets in Europe, so a very risk-on tone. And given, I guess obviously that was in anticipation that we've reached peak rates, but given that central banks are still hiking, and we have seen some positive data points, but it still hasn't created a trend. So yeah, I think there is some caution to be warranted.
So do you think, Hannah, is this because we haven't reached peak rates, or because the market is not realizing that even if we have reached peak rates, they stay here for much longer?
I think this is the key thing to focus on. How sticky will inflation be? Perhaps we are approaching key rates now, and we do anticipate in this quarter we will have reached peak rates, but it's then what the trend is from there, and I think perhaps that's what maybe has been missed in terms of the market reaction.
Okay, so you see, and the IMF actually, and you rightly said, of course, they worry about the UK, everything else seems a little bit better because of what's happening in the US and also the China reopening. What does the China reopening mean for how you play the markets?
China reopening is really interesting because emerging markets, I guess if we look at China and its impact on emerging markets, obviously takes up a huge portion of the emerging markets index. It really means that it's going to take away some of the concerns that we had in terms of the global growth outlook, and also Europe is going to benefit because it's a key trade partner there. So I think that it's a big positive, given the IMF predicts it's going to grow 5.9% in 2023. That's obviously a huge number and very positive for the overall economy. I think in terms of the outlook and positioning, it means that emerging markets look more attractive. Obviously, the valuations have been very attractive. They're trading at about a 30% discount to the developed markets. So it just opens up the window of opportunity when it comes to positioning for clients.
So where specifically in emerging markets, and is there a range, a danger that there's like a delayed default effect, so a second and third round effect of these higher interest rates that will play out mid this year?
Yeah, I think within emerging markets, as you say, you have to be more tactical. So Latin America, where they're big commodity exporters, is an interesting place to play within emerging markets. Obviously, caution is warranted, and whilst we have seen attractive valuations, there had been the concern around the zero COVID. I think when we looked at the Lunar New Year, that was a key milestone in terms of whether the COVID cases would spike and whether there would be restrictions. We didn't see that materialize. So it does seem that emerging markets, the reopening is here to stay, which has positive implications for the economy.
Okay, we're going around the world in like 6 minutes. Talk to me about the European Central Bank. Is this the one that could surprise the most?
Yeah, I think for the European Central Bank, we're expecting a 50 basis point hike there. I think that The concern with Europe is that the positive or the softer inflation has really been due to a milder winter, and so obviously that is seasonal and that could change. But I think that it's the central bank has to stay nimble in terms of its approach, and so we're probably expecting 50 basis points in this round and 50 basis points again. But I think cautiously optimistic. The inflation numbers have been a little bit more optimistic, but still need to be careful there.
And Bank of England? I mean, it just seems like a nightmare, actually, how to get it right.
Yeah, I think Bank of England, obviously, the positive for Bank of England is that they started hiking first, and so they are a little bit ahead of the curve in that regard. But I think it's really going to be data dependent. A lot of people questioning whether this could be the last hike. I think really it depends on the data that we see coming out from here.
Hannah, overall, is there something that you're selling right now? So we're listening, we talk a lot about automation. I think that the new hot thing is AI. I don't know whether this is partly why we're also seeing job losses in, tech companies, in banks, or whether this is just working our way through some of the overhangs.
Yeah, I think generally when we look at our positioning, so we previously were underweight equities. We've now moved to a slight overweight, but really in the defensive, so being a little bit more selective in the equity selection. Cyclicals at the moment still quite expensive, not screaming great value, and given the sensitivity of the economy and the global market recovery, I think if you are playing in equities, you really want to stay in those defensive companies which have strong, stable dividends and are likely to have strong earnings resilience as well.
Okay, thank you so much, Hannah Smith, their Vice President for State Street's ETF business. Now, we're also getting some breaking news out of UniCredit and UBS. So let's do a quick market check for both of them. UBS, let's look at the share price. I think we have it. There you go. UBS down 2.2%. Now, the profit did beat estimates as some of the rates offset some of the trading slowdown, but maybe a lot of the market participants are really looking at a slump in trading fees and transaction income at the key wealth management business for something that they're concerned about going forward. The other story is UniCredit. Now, UniCredit is also reaping benefits of the rate rises, and they're basically saying that they're boosting returns. Now, the chief executive did hint at this to us in Davos, but they're basically saying that because they posted net income of about 2.5 billion euros in the final quarter of last year, they plan to distribute 5.2 billion euros in a mix of cash dividends and share buybacks on the 2022 earnings. So it's 40% more than a year earlier, and you can see that share price getting 8%. Coming up, a big bank beat and $5 billion in buyback. We just talked about it. UBS earnings offered far more than alliteration. More on that next. This is Bloomberg.
Typically, between the time you start and they get out in the farmers' fields, is about 8 years. Now, we have a pipeline of innovations. We've been funding the CG system for 20 years now. It's funded at about $1 billion a year. If people care at all about adaptation, that thing will be funded at $2 billion a year. I mean, there won't be anything close to the impact of climate-related seeds, climate-related maize, rice, wheat, sorghum, millet. And thank goodness, because of human genetics, we know how to do the editing. Thank goodness, because of AI, we know how to find the alleles. Because of drones, we can measure stuff in the field. So there's huge advance in terms of how the whole seed ecosystem moves at full speed.
So you've got to explain this one to me. What does it mean when the White House says we're watching markets carefully?
It means they have a Bloomberg.
I've seen the Bloomberg.
They have
I've been in and seen it.
Lots of Bloombergs. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg.
I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. What does it mean? What does it mean? What does it mean? What does it mean? What does it mean?
It means they have a Bloomberg.
Welcome back to Bloomberg Daybreak Europe.
Good morning, good morning. This is Bloomberg Surveillance.
Welcome to Bloomberg Markets, China Open.
This is Bloomberg Technology.
To our television and radio audiences worldwide, welcome now to Balance of Power.
This is Bloomberg. Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question.
Best question I get all night.
Bloomberg, top experts, great questions. As growth forecasts are increasing and inflation is falling, will the European Central Bank make its fifth rate hike in a row? How high do rates need to go? Bloomberg Television and Radio brings you the breaking news from Frankfurt and detailed analysis after ECB President Christine Lagarde's press conference.
The central banks, and certainly the ECB is pushing this line, have got much more wood to chop. They've got much further to go.
Coverage begins Thursday, only on Bloomberg, your global business authority.
Welcome back to the Open, everyone. 14 minutes into the European trading day, we're seeing a bit of pressure across the board. Stocks overall down 0.2%. Of course, investors positioning themselves for interest rate hikes this week from the Federal Reserve and the European Central Bank. Now, UBS fourth quarter profit beat expectations and said it plans to buy back more than $5 billion this year. Rising interest rates helped offset a slump in trading fees and transaction income at the key wealth management business. Well, Armanis Krani spoke to Chief Executive Officer Ralph Hammers in Zurich.
If the investor confidence is there and they are going to go risk on, our investors and our advice will always be, okay, what does leverage cost you? Because you should realize that vis-a-vis the last decade with very low rates, leverage was almost free. Leverage going forward is not almost free. It will come at a cost. So that will be a different perspective in terms of taking on further leverage or not. We do expect at a certain moment that to turn and leverage to come back into the market. In Asia, we've seen more towards the end of the fourth quarter. We've seen some stopping of the deleveraging there, but it's too early to tell whether that's a trend.
Big buyback, $5 billion. Good sign of confidence?
It's a sign of confidence. It's a sign of the strength of our franchise, really. We have a highly capital generative business. We have a capital light business. We have the momentum with our clients. We are generating that capital. What is important for us is that we always keep a strong balance sheet for events or risks to come through. We're conservative in risk, but nevertheless, you have to be aware of that. Second, if we can grow, we will grow, if that will cost some capital as well. But then it's all about attractive progressive dividend and a share buyback. And we have confidence that we can buy back over $5 billion in this year.
UBS Chief Executive Ralph Hammers speaking to Bloomberg's Armanis Krani. Now, coming up, we are joined by Bjorn Sibbern, NASDAQ's president of European markets. We talk capital markets, of course, IPOs, and the health of the global economy. That interview is shortly, and this is Bloomberg.
Everybody want to be a consultant, and what are all these consultants doing?
Well, David, I think that we actually defy the label consultant, because sometimes consultant seems to imply that we only give advice. And when you look at what Accenture does, we're really different than the traditional version of a consultant. We're really about relevance and results, and that's what is driving our business.
What about a consulting project? In my example, I'm the CEO, I have a problem, I call you up, I say, solve my problem or give me a solution.
We don't operate as big companies permanently in crisis mode. And so when you think about like how long does it solve things, a lot of it starts with, you know, the company being willing to set aggressive goals. And so what we are trying to do now is work with our clients to work differently and to work faster.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Welcome back to the Open, everyone. 19 minutes into European trading day. The picture, one of caution ahead of a lot of central bank decisions. European stocks down 0.2%. Now, markets will be confronted with 6 major issues this year. Inflation, China's reopening, of course, dominating the macroeconomic backdrop. Amongst market dynamics, yield curve, prospects of an equities bear market, the fate of the dollar, and liquidity will also be key drivers. And 2023 is expected to be another volatile year as a result. So what does that mean, more or less, for businesses, for bourses like NASDAQ? Well, I'm delighted to be joined now by NASDAQ's President of European Markets. He's Bjorn Sibbern. Bjorn, thank you so much for coming on, and actually, you know, welcome to London. When you look at some of the prospects for the next 12 months, is it going to be easier or harder to attract business?
So first of all, thanks for having me here. So if you look at, and you mentioned some of the risk factors. If we look at last year, we ended last year with a lot of risk factors. You mentioned inflation, you mentioned the war in Ukraine, energy crisis. So a lot of uncertainty. We still have many of those risk factors in the market today. You would say some of them have taken a little bit down, inflation, the energy crisis, but many of the risk factors are still there. So what does that mean? Many investors, they want to have predictability. So when you look at the IPO pipeline, it is still healthy. We have not seen cancellations of IPOs, but more IPOs being postponed. So we still have a healthy pipeline when it comes to IPOs for this year.
Bjorn, and you're here basically in Europe also you're based in Europe to try and muster business, right, for NASDAQ. Does it make sense for a company, if they're, for example, a tech company, to be listed in Europe instead of being listed in New York, where you have a lot more liquidity and access to investors?
So if you look at 2021, which was a record year for us, we listed more than 209 companies in the Nordics, which was an amazing year. I think we had a great mix between big companies, tech companies, but also many SME companies. So for companies to list, whether they want to list with NASDAQ in US or in Europe, it depends a little bit on the company's journey. But to give you one example, in 2021, we listed Volvo Cars, and they got 200,000 retail investors as a part of their journey. They listed in Stockholm because they have a massive investor base, both institutional and retail. So it depends a little bit on the company's journey and also which sector you're in.
But what would you need from Europe, so from the Commission, to make the business in Europe better? Is it a capital markets union? Are we even going to get something significant, banking union, in our lifetime?
So what is important for NASDAQ, and I think that's also relevant for the European Union, is we should focus much more on SME companies. What we spend a lot of time on, our goal, ambition, is to be the leading SME listing venue in Europe. I think we are that. And I think actually when we discuss things in Brussels, I think actually help SME companies get access to capital so they can grow, create jobs. What we have seen with companies that list with us on our First North segment, the growth segment, they create more jobs than their benchmarks, simply because they get access to capital. They have higher ambitions around growing from Sweden into Europe and bigger marketing budgets. So companies that get access to capital on the exchanges grow faster than their peers. And there's one more dimension that is important. There's also the retail investors. When you list companies, SME companies, you also give retail investors access to invest in those companies. That will be the new Google.
But Bjorn, are they considered more risky because small, if funding is more difficult? They're usually companies that create a lot of jobs, but also are much more prone to interest rate swings.
Yes, but you're right. So with many of the small companies, the First North, the growth companies, they are more at risk, and you see some of them will not make it. But what is important here is that investors know what they're doing. They are aware of the risk. They invest, let's say, in 5, 10 different companies. Some of them will do fantastic. Some of them will struggle. But what is important with our SME segments, First North, during the last 10 years, we have had 100 companies moving from the First North SME segment to the main market. So basically, the company has grown so much, so they actually elevated themselves to our main market.
Bjorn, are you benefiting from Brexit?
Yeah, I think actually UK lost some momentum because of Brexit. We saw, and we have had a fantastic momentum on our First North SME market for the last 5 years. We have been most successful in terms of number of listings. So yes, some of the uncertainty where some looked at UK, they are looking more towards, and when I say Nordic, it's mainly Sweden. Yeah. Sweden has been the most successful listing market in Europe for quite many years.
I mean, can you pinpoint as to why? If you look at the UK, nothing's really changed in terms of rule of law. So is it access to capital? Is it the pool of investors in London that have left, and so people see more opportunities elsewhere, or is it the regulatory system?
I think actually where Sweden has been fantastic, and it's not credited only to Nasdaq, it is also credited to the political landscape in Sweden, where they decided to focus on equity markets, raising capital through the exchanges instead of bank financing. So created a special saving account for retail investors. So we have seen a massive interest from retail investors in listed companies, and also in buying into new IPOs. So the mix of a sophisticated retail investor base with a lot of education by the online banks and brokers in the Nordics, combined with pretty sophisticated advice as well. So it's the whole cluster around that has worked super well for the last 10 years.
But can you really compete actually with France or Germany?
Yes, for sure. Especially Sweden can. It has been very, very successful and been the most successful in terms of number of listings for SMEs if you look at the last 5 years. Basically because we have such a great liquidity pool with the mix of institutional investors, retail investors, local investors, and foreign investors. So yes, it is possible. But it's a journey. You need to educate, you need to build it, and it takes years.
Bjorn, thank you so much for coming on today. That it was Bjorn Sieber, Nasdaq's president of European markets. We'll have to get you on also to talk about some of the green finance, right? Maybe this is a way of attracting capital away from the U.S.
Yes.
All right, you'll be back. Coming up, Ford in Europe, we hear more on how the car maker is handling economic headwinds and slashing its latest EV prices to rival Tesla. I'm looking at UBS shares. They're falling after banks reported some of the mixed results. Our Manus Cranny was on the field in Zurich. He had a great interview with the UBS chief executive officer. Look, the share price could be surprising to some. I am going through some of the global equity markets bank statements, and they say that UBS's core wealth management still doing all right. The lagging trading and investment banking results, though, disappointed. So a lot of the good news, like the benefits of higher interest rates, seem to be reflected in the share price already, given UBS's stock gained more than 40% since an October low. So you can see UBS in today's trading session down 2.5%. This is Bloomberg. what do you say to the cynics that say, look, it's all nice and fine, but a lot of it is greenwashing, and you're not a good company, you're just a less toxic company than some of the other oil majors?
Well, the first thing to say is that, you know, I'm a big believer in we need to put ourselves in other person's shoes in life in general. And so I understand that point of view, and I get that people have that perspective. I don't agree with that, obviously, but I understand where they're coming from. We have an enormous challenge as society, which is to provide the world with reliable, affordable, and clean energy. That's what society wants. That's what society needs. And I believe in my heart that a company like BP is actually one of the few companies in the world who can actually make that happen. We can talk about the things that we're going to grow and over the coming years, and I find it hugely exciting and energizing for our organization. But that's what the world needs, and you simply can't go against the grain of society. You can't defy gravity, and that's why we're making the change that we're making.
Welcome back to the Open, everyone. 30 minutes into the European trading day, and here are your top stories. The IMF raises its global economic outlook for the first time in 1 year as resilient U.S. spending and China's reopening fuel demand. UBS beats profit at the Swiss lender, tops estimates that it announces a more than $5 billion share buyback, while the chief executive, Ralph Hammer, says shareholder returns are an important part of the business strategy.
If we can grow, we will grow, if that will cost some capital as well. But then it's all about attractive progressive dividend and the share buyback. And we have confidence that we can buy back over $5 billion in this year.
Plus, France unexpectedly grows in the fourth quarter, boosted by investment and net trade. We turn our attention to euro area figures out a little bit later this morning. This is a picture for markets across the board. Bit of pressure. European stocks down some 0.3%. The FTSE actually accelerating its decline 0.5% lower. There's a flurry of corporate earnings, some better than expected, some worse than expected. Of course, some economic data. The markets also trying to position themselves ahead of interest rate hikes later this week. It's not only the Federal Reserve, it's not only the European Central Bank, but it is also the Bank of England. So some of the main things that we're watching, let's look at the sectors on the move. That usually gives a good indication of what earnings did better than expected and the ones that did worse. Banks, so I have UniCredit gaining some 8% because they've given more buyback. Banks, top gainer, 0.2% higher. We have food and beverage also gaining 0.2%. And then the rest is on the downside with real estate lower by more than 1%. So some of the individual stocks, I know there's pets at home. We'll get to that in a second because everybody loves fluffy kittens and little puppies. But UBS under pressure now. They are benefiting, much like UniCredit, from higher interest rates, but they disappointed on some metrics on the wealth. So this probably explains a bit of pressure on the downside, although they did beat in terms of earnings overall. So there are also questions are maybe the market was expecting too much. Longer term, UBS, that share price gained 40% since October, so it also explains a 2% fall today. UniCredit doing quite well because of interest rate rises, and so they're giving back more to shareholders, and then Swedbank also getting 2.8% after beating estimates. Now, in the midst of this earnings season, we also await a slew of economic data ahead of the ECB decision on Thursday. Now, in France, inflation actually came in at 7% in the year to January. The economy grew 0.1% at the fourth quarter. Joining us to break down these numbers, our Europe correspondent Maria Tadeo in Brussels. Maria, good morning. So nice to see you. So what are the French readings actually telling us?
Well, Francine, good morning to you too. And there's two things here. When you look at growth and GDP, the French economy did escape a contraction at the end of last year. The economy grew 0.1% in the fourth quarter. And granted, this is not fireworks growth, but economists were expecting no growth at all. When you look at inflation on an annual basis, of course, that's accelerating 2 to 7%. This is a general story across Europe. Remember, it was a challenging year on the energy front, 2022 in general. But to me, Francine, this is now a forward-looking story. When you look at GDP, the French president, Emmanuel Macron, he is determined to get that pension reform going. But of course, that means strikes. Today, there are more strikes planned. The question is, will this have an impact on the French economy? You sat down with Bruno Le Maire. He told you he did not expect a material impact. But of course, that we need to wait and see how this situation develops. And then secondly, when you look at inflation, the French government by now has made it clear that this idea, the time of whatever it takes, whatever it costs, will have to be reduced. The state cannot pay and subsidize more.
And we're also waiting for data from Italy and the broader Eurozone as well. What does this all mean for the ECB, apart from having a big headache?
Indeed. And Francine, of course, we'll see you there on Frankfurt on Thursday when that decision comes. We've had Spanish inflation. We've had the French. We are waiting for data from Italy and obviously the big GDP number for the euro area. Now, overall, Francine, on Thursday, when you look at economists, has fully priced a 50 basis points hike from the ECB. But the real question is, given the inflation data that we've had so far, will that actually boost the argument from the hawks that you need to continue to go hard on it and potentially push for another 50 basis points come March? The real debate to some extent is not about this week, but it's March.
Thank you so much. Our Europe correspondent, Maria Tadeo, there with the facts and figures and some of the data. Now, Ford recently announced about 3,200 job cuts in Europe to be centered in Germany as a car maker slashes costs to help finance its electrification plans. Bloomberg's Oliver Crook joins us from a Ford factory in Cologne. Oliver, good morning. What's Ford doing and how does it actually fit into the broader economic picture?
Good morning, Francine. Yeah, I mean, the factory here in Cologne is a huge manufacturing site for Ford, and really it serves as a symbol for what's going on in the broader automotive industry. As we speak, they're converting this factory from creating combustion vehicles to creating EVs, and they're dumping $2 billion into this process here in Europe in order to do that. It has big implications for, as you say, for jobs, but also for the future of the auto industry. By the end of 2030, they want to have every car in this parking lot be an EV. These are all combustion engines right now, and it comes at a time for manufacturing that's been quite strained in post the pandemic and a lot of costs going up. So I chatted with the man who's in charge of the electrification drive here in Europe, Martin Zander, and here's what he had to tell me about inflation.
In general, when it comes to semiconductors, we see the challenges of the last year's ease, so supply is clearly picking up. In general, we see costs coming down, maybe not to normal levels. Also, energy costs, of course, still higher than a couple of years ago. But overall, we see the cost pressure coming back from the challenges we've seen maybe half a year ago.
So costs still higher, but we're seeing that some of that inflation coming down a little bit, at least trickling into the manufacturing sector.
So, Ollie, in the U.S., Ford has cut the price of its Mustang Mach-E. What does that tell us about the transition to electric?
So it tells you a lot about the competition that's going on right now in the EV sector. So this was a direct response to Tesla, which cut the pricing of its Model Y. The Mach-E competes directly with that. And it tells you about the competition for market share in this sector. But that's not the only competition you need to worry about. Here in Europe, the focus is much more on the mass market vehicles. And for EVs, what you need a lot of are chips and battery cells. And those are in very low supply right now. So that's another competition, to get a hold of all of these materials. And if Europe wants to reach its electrification goals, this is one thing I spoke to Martin Zander about. He says they need to be very proactive. Have a listen.
I think the most important thing is not to react to anything what's going on in the world, yeah, IRA or anything else, but have a European comprehensive scheme to support this massive transition, because we need investments everywhere, in charging infrastructure, in production of electric vehicles, in production of EV components, all the way down to the processing of raw materials.
And you see some of that proactivity on display this week, particularly on raw materials. Schultz in the lithium triangle visiting Chile and Argentina, trying to secure supplies of those raw materials that are very key for the future of production here in Germany.
Yeah, and Ollie, of course, one of the big things we're watching is also the European Union in general, just fighting back with possible subsidies against the IRA program. So how does this fit in with the Germany electrification story?
Well, this is a big question. The IRA, you know, for some, it can be considered, you know, in Germany, you have 20% of the economy is still manufacturing. That is a massive part of the economy compared to other services-driven developed markets. And so when you have something like the IRA coming in that could really upend and move some of that production out of Germany, out of Europe, it's a major concern for the Europeans. So whether they get under the umbrella of the IRA seems maybe not a likely outcome, or they develop their own scheme in order to boost this EV and this electrification push. It's going to be a big question going forward, and it's one that is not yet resolved.
Thank you so much, Ollie Crook there in Germany. We'll have plenty more, of course, throughout the day. Also coming up, a big bank beat and $5 billion in buybacks. We'll hear more from the UBS chief executive next. This is Bloomberg.
We're investing in a lot of different capabilities and features that makes the in-store shopping experience that much easier, that much more compelling, whether it's price check, browsing inventory in this store, so that we can really make that experience as convenient and as simple as possible.
Convenient, simple, that's sort of what people have needed in the age of COVID. Is that here to stay, or do we go back when finally we all hope that the pandemic will be behind us in some way? Do our changing shopping habits go back again?
What's really interesting about retail in my 20-plus experience is that convenience never reverts itself. Now, the form of convenience has shifted, whereas, say, in 2000 to 2010, a lot of convenience was driven by more stores nearby. Now it's stores in addition to digital. There's nothing closer than the phone in your hand.
News breaks. No one covers the world like Bloomberg.
Return to pragmatism is really that everybody's in line. The government, the enterprises, the people, in pushing this economy. It's like a cycle of renewal.
Big tech layoffs rolling in. Spotify, the latest to tighten its belt, with plans to cut 6% of its employees.
Is the economy unfolding as you thought it would?
I think the economy is responding to work that the Federal Reserve is doing.
Bloomberg, your global business authority.
Welcome back to the Open, everyone. 41 minutes into the European trading day. Still, markets under pressure, down 0.4%, looking at central banks, the Fed, the ECB, and the Bank of England, but also looking at earnings. UBS has reported fourth quarter profit that beat expectations and said it plans to buy back more than $5 billion of shares this year. That says rising interest rates helped offset a slump in trading fees at the key wealth management business. Bloomberg's Manus Krani spoke to the UBS chief executive, Ralph Hammers.
Indeed, we had a very good set of numbers in the fourth quarter, and not only on the income side, but specifically also on the underlying flow side. 23 billion of net new fee-generating assets, 11 billion of net new money, 9 billion of net new deposits, basically showing the trust of our customers to basically place the money with us and for us to help them manage it. On the back of that, clearly with lower market values on the fee income, that was a bit lower, but the interest income really came through. It is very much the dollar effect and the Swiss franc effect now as well. On the dollar effect, we feel most likely peaked. However, there is more to come on euro and certainly also on the Swiss franc.
Just on those central banks, we caught up 2 weeks ago, and there was the feeling that maybe we're near the top of these central banks in terms of the hiking cycle, specifically the Fed. Paul Krugman joined us yesterday and he said, be careful, stop getting over your skis and overconfident on inflation. Are you overconfident that we've peaked on inflation?
We may have peaked on inflation, but it doesn't mean that the central banks will not further increase some rates, just to be sure. I do think that they are very clear in terms of what they want to achieve. They really want to get the structural inflation down. And that could come along with a real deceleration of economic growth. I think the recipe is that we rather have a short-term pain with a long-term gain than not being tough enough in order to get that inflation back to that level. And that is what I think central banks have in their minds.
In the fourth quarter, you've had some short-term pain. The fees were down 17%, transactions were down 19%. Is that the worst? Is that the nadir of the sidelining of wealth management clients?
Well, if you look at the different components on the wealth management side, so first, what is important is that you see that the trust is there and that clients come to you. That basically shows that we have the right professional services, we have the right products, we have the right advice, we can take them through a period of challenges and unclarity. That period of unclarity is still there, right? So we see positive news coming from China, we see positive news coming on also inflation. We see some life back in the leveraged capital markets, which is normally a leading indicator. However, all early movements. So I don't think there is a trend there yet. So for the moment, I do think that our clients are hopeful, but in a wait-and-see pattern.
Well, there has been a move to risk on assets. This is the debate. We're 1 month in. There's been a move to risk on assets. You use the word sideline for wealth management clients in the fourth quarter. Are they nibbling? Are they active in acquiring risk on assets?
That's not what we see. We truly see that they are waiting for more clarity to come. And I think that's wise. We really want to make sure that there is more visibility. I do think that the coming weeks will bring that more visibility. We see there are central banks coming to the market. We see the Chinese New Year's behind us and see whether the positivism coming from China will continue. We see corporate earnings coming through in the next couple of weeks as well. So I think the next couple of weeks from different sides will give us much more data points to get a feel for should we be risk on or not.
Fit or kill on risk on in the next couple of months. The other aspect for me is the re-leveraging. Every time we get together, you say deleveraging in Asia, deleveraging. Is 2023 going to be the year of re-leveraging given the boom, the sort of the mini boost that we've had from China?
Well, it really depends. So if the investor confidence is there and they are going to go risk on, our investors and our advice will always be, okay, what does leverage cost you? Because you should realize that vis-a-vis the last decade with very low rates, leverage was almost free. Leverage going forward is not almost free. It will come at a cost. So that will be a different perspective in terms of taking on further leverage or not. We do expect at a certain moment that to turn and leverage to come back into the market. In Asia, we've seen more towards the end of the fourth quarter. We've seen some stopping of the deleveraging there. But it's too early to tell whether that's a trend.
UBS Chief Executive Ralph Hammer speaking to Manus Cranny. We also have some data points today that we need to spend a bit of time on. France unexpectedly growing amid the European recession. Now, these numbers, together with some pretty strong Irish growth, offer some relief for Europe after data yesterday revealed an unexpected downturn in Germany in the final 3 months of the year. What this means for the ECB, unclear going forward. We have a great piece by Bloomberg Economics saying the ECB will likely hike 50 basis points in February and March and then 25 basis points in May, but it's certainly moving yields across the board a touch, with the German 10-year yield at 2.284. Now let's get straight to the Bloomberg First Word News with Adrian Wong in Hong Kong. Hi, Adrian.
Thanks, Francine. French labour unions are leading a second day of mass strikes and protests against government plans to raising the retirement age. The country's rail operator, SNCF, predicts only 1/3 of high-speed trains will run and urge people to work from home. Widespread disruption is expected on the Paris subway, with many schools also closed. Analysis by Bloomberg Economics has found Brexit is costing the UK economy £100 billion a year. That's about 4% of GDP. 3 years on from leaving the EU, the research found effects spanning everything from business investment to the ability of companies to hire workers. Separately, the IMF forecasts the UK will be the only G7 economy to shrink this year, with growth remaining sluggish in 2024. The International Monetary Fund has raised its global economic growth outlook for the first time in a year. It now sees GDP expanding 2.9% in 2023. That's 0.2 percentage points more than its October forecast. The IMF says resilient US spending and China's reopening will help buttress demand. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. This is Bloomberg. Francine.
Adrian, thank you. Adrian Wong in Hong Kong. Coming up, the under siege Adani Group gets a big boost from UAE royals as the sell-off in the Indian conglomerate continues. We'll have more on that next. This is Bloomberg.
The innovation agenda is going full speed on mitigation. That's where, you know, there's 100 companies, Breakthrough Energy's funded. There's
by mitigation, you mean mostly energy. You mean everything to do with energy. You mean generation of energy. You mean batteries. You mean transport. You mean all of the new, and there's some renewables that are already traditional, but more that need to come on. So that's the package that you're talking about mitigation? Yeah. Or are you also talking about agriculture as mitigation?
Yeah, so every area of emissions, you know, the world tends to focus on passenger cars and electricity. That's not a third of emissions. And so the focus on the easiest third, you know, now 4% of new cars are electric, you know, so that's the field that we're furthest along. About 4% of energy generation is wind and solar.
DOJ or other authorities
could face bigger challenges next.
Was going to keep rate World Cup. This is a 3.
As the economic picture does. The BOK is getting ready to make a decision.
Welcome back to the Open, everyone. 52 minutes into the European trading day. Not only are investors looking at a slew of earnings, a lot of better than expected figures and earnings from banks, but they're looking at data points and, of course, wondering what not only the Fed, ECB, and Bank of England will do later this week and by how much they'll tighten. India is set to unveil its budget on Wednesday, testing Prime Minister Narendra Modi's fiscal resolve ahead of the 2024 elections. Bloomberg's Menaka Doshi reports on what to expect.
India's Finance Minister, Nirmala Sitharaman, presents her government's finances on February 1st. She'll be grappling with a global recessionary chill on economic activity and the heat of an impending general election. Economists expect the government to stay the course on reducing the budget deficit, directing expenditure towards infrastructure, rural welfare schemes, and manufacturing.
Make no mistake, probably more infrastructure spending is always a good thing in India, and the economy fundamentally has really turned a corner. There's something going on in India in terms of industrialization, manufacturing coming back.
India will seek to build on the early success of drawing more Apple suppliers. To replicate that in other industries, it is being urged to cut import duties across value chains, from chemicals to solar power. Boosting consumption, private sector investment, and jobs will be priorities for Narendra Modi as he pursues a third term as Prime Minister of what is now the world's most populous nation.
Manaka Doshar, Bloomberg editor on the Indian budget. Abu Dhabi's international holding company is investing about $400 million in Adani follow-on share sale. Now, it's a vote of confidence in the business empire that has lost around $75 billion in market value since a short seller accused it of fraud, allegations it denies. Bloomberg's conglomerates reporter PR Sanjay is in Mumbai. Sanjay, so what's the latest with the share sale?
Hi. So what we are picking as, from the stock exchange's disclosures, the issue is like 80% subscribed and 91% is a threshold. So going by the demand and going by the demand from QIBs, we expect that it will be covered. The issue will be successful. But what company is saying that it's already 1.2 times, subscribed. One will have to wait and watch for the actual figures. But what changed was from yesterday night, the IHC invested $400 million, and that is followed by many other investors. So we are waiting for the exact breakup that will come in few hours.
So, Sanjay, after the commitment from Abu Dhabi's IHC, do you see more financial institutions actually joining the Adani share sale?
Indeed, more financial institutions have helped this FPO to sail through. Otherwise, they have lost a lot of confidence. And yesterday, investment house with credibility, like IHC had put, and they were on record saying that they believe in this company. So that have triggered many other financial institutions to come on board. And we are waiting for the exact names and what is the kind of the commitment made by these financial institutions. That will be clear in few hours from now.
Thank you so much for joining us. Bloomberg's conglomerates reporter PR Sanjay in Mumbai. So that's it for European Market Open. Surveillance Early Edition is up next. The picture across the board is one of tentativeness. We not only had some data out of Europe this morning, I would suggest France, the biggest story in terms of data points, unexpectedly growing amid some of the recession fears that we've seen. Gross domestic product, in fact, in France rose 0.1% in the fourth quarter, supported by investment and net trade. Now, the numbers, together with strong Irish growth figures, of course, offer some relief for Europe after data yesterday revealed an unexpected downturn in Germany and higher than expected inflation numbers in Spain. Just a reminder, figures for the entire euro area are due out at 11 a.m. Analysts overall see a small contraction. While Surveillance Early Edition continues or is up next, we look at some of the main stocks to watch. We look at earnings and banks. This is Bloomberg.
write a book about YouTube now? Why'd you do this project?
Yeah, YouTube is this kind of a sleeping giant in social media. Someone described it as like this iceberg that no one ever really talks about as much for a variety of reasons. I see YouTube as both the past and now future of social media, and it was the first company to pay online broadcasters and invented the creator economy. And now we're seeing with TikTok, Instagram, Snapchat, are all moving in this direction. Social media is no longer your friends and family and your acquaintances. It is influencers. It is celebrity. It is a game built around commerce. And this is a world that YouTube very much created.
Should we be telling Odd Lots listeners to like, comment, and subscribe? Other podcasts do that.
I mean, it's an effective call to action.
All right, everyone, like, comment, and subscribe on Odd Lots wherever you find it.
The top names in business are on Bloomberg.
More and more people are frightened of the realities of today, and that's manifesting in so many areas. Why would anybody put something into a 30-year obligation unless you believe something is better in 30 years? I'm not here to suggest it's going to be rosy in 2023, but what I'm saying for long-term investing, it's a better environment for long-term investing today than it was 2 years ago.
Nobody covers business like Bloomberg, your global business authority.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
Is Bloomberg Surveillance, Early Edition, with Francine Lacqua.
Good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Here's what's coming up on today's program. The IMF raises its global economic outlook for the first time in a year, but it predicts the UK will be the only G7 member in recession in 2023. France unexpectedly grows in the fourth quarter. GDP rose 0.1%, boosted by investment and net trade. We turn our attention to the euro area figures out at 11 a.m. And UBS tops estimates and announces a more than $5 billion share buyback. The chief executive, Ralph Hammers, says shareholder returns are an important part of the business strategy.
If we can grow, we will grow. If that will cost some capital as well. But then it's all about attractive progressive dividend and a share buyback, and we have confidence that we can buy back over $5 billion in this year.
Let's check on the markets. The pictures across equities is one of actually a downturn. So we're seeing futures in the U.S., we're seeing European shares down. Investors positioning for interest rate hikes this week from the Federal Reserve, but also the European Central Bank. Now, the sell-off in Adani Group also continues, with 10 of the conglomerate's companies seeing about $75 billion in market valuation erased. And there's a beautiful piece by Shirley Wren, basically says, watch out for second and third round effects. If there's a margin call, then this is something that could go down quite, well, in an ugly manner. We also look at data, of course, here in Europe. We had not only that French GDP, but we look at the overall Eurozone a little bit later. That's at 11 o'clock UK time. This is the picture across the board for a lot of the European stocks. Now, handing over everything, of course, is Wednesday's Federal Reserve decision. The U.S. Central Bank widely expect to raise rates by 0.25 percentage points, and then investors will be watching for tones from officials for future meetings after Jay Powell's consistent efforts really to push back against traders anticipating rate cuts later this year. U.S. and European stock futures and Asian shares falling today, as we were just saying. Investors positioned for interest rate hikes later this week. So let's get straight to it. Let's get to Meera Chandan, JP Morgan co-head of Global FX Strategy, and Bloomberg's Christina Aquino. Thank you both for joining us. Meera, great to speak to you today. What are markets getting wrong in this kind of environment? Are they expecting too much from the Fed that, we hike, we're at peak inflation, and then they cut at the end of the year?
Yeah, absolutely, Francine. I think that's the big risk here is that the market is putting too much weight on the Fed delivering rate cuts at by the end of this year. And I think the one thing that Jay Powell, as you mentioned, will push back on today is actually that market's pricing. Whether the FX market actually responds to that is a whole different story, but certainly that's the line that he will be towing.
Is there anything underlying some of the concern of what markets don't understand? I don't know whether it's a neutral rate, and the neutral rate is difficult to define and keeps on moving.
The key issue here is that some of the survey metrics that we're seeing from the U.S., some of the data are actually showing that the probability of recession is pretty high, and there's an underlying belief that the Fed will step in, inflation is going to cool, and the Fed's going to step in to support growth, and that's really the key source of contention. The problem here, of course, is, and what the Fed is highlighting and what we've been saying, is that inflation is actually not going to come off to the extent that the market expects, so that could actually cause the Fed to stay on a high, at a high interest rate level for a longer period of time.
And Christine, I guess you look at that and you also put it in the context of earnings, and better than expected earnings in banks, but a lot of them were priced in before.
Absolutely, Francine. And really for earnings season, what you really want to look at is all the outlooks that banks and really all companies are delivering. And it really points to quite an uncertain and bleak future, right? From all the cost cutting and layoffs that we've seen, as well as just any effort by companies to really keep their ships tight. Because it's going to be an uncertain, stormy period ahead, and they really don't know what's going to happen. Maybe we go into recession, maybe not, but you really can get the sense from this earnings season that companies just want to be prepared for the worst case scenario while hoping for the best.
I mean, was there too much of a rally in January? And this is one of the questions, maybe markets got ahead of themselves looking at earnings. Was that really realizing what it went for market share?
Yeah, I mean, there's definitely the question of have we gone too far? But, you know, given that 2022 was really such a terrible year for most asset markets, right? January was bound to be a bit of a bounce, right? But I think February is when markets will really have to come face to face with the reality that we're in, which is that inflation is still high and central banks are still struggling to contain that. And really it becomes a question of how much can central banks tolerate inflation while they've come down from all-time highs that we've seen, will still be above target. How much tolerance will they have for that? And that's really the big question.
The big question. Terminal Fed fund rates, what do they tell us about what happens to dollar from now on?
Look, the terminal Fed funds rate is around 5%. The dollar itself is not just about the U.S. When the market was repricing the Fed, it was obviously in large part the dollar strength was about that repricing. I think there is a second important ingredient to dollar strength or weakness, which is what is the rest of the world doing compared to the U.S. And the big difference here is that actually China and European growth is beating expectations, doing much better than expected, whereas U.S. is slowing down. So really the Fed doesn't really have much ability to change that picture. So I think you could have a situation where so long as China is growing well and Europe is growing well, even if the Fed is hawkish, actually the dollar continues to weaken because it's focusing on growth rather than the Fed.
What exactly are you expecting from Jay Powell? Is he going to push back against some of, you know, the I guess, looser financial conditions that the market narrative seems to be pushing?
Absolutely. I mean, I think there is a pushback that should come against the market pricing of rate cards. There's the fact that we've had an easing in financial conditions. It's the opposite probably of what they want. But like I said, there's not much that Powell can do to change the growth picture globally, and this is being driven by very real factors. The dollar weakness is being driven by very real factors outside the U.S. What they could do is try and take some of the froth out of the equity markets, and that's why we do think that there is going to be a hard line that he adopts. But at the end of the day, market's going to focus on inflation coming off in the U.S. and the Fed coming to a pause.
Yeah, and Christy, if you look at IMF, I mean, they were much better than expected overall for forecasts going forward, and this is thanks to U.S. strength, but also the China reopening.
Absolutely, Francine. It is quite fascinating because you have the two world's biggest economies kind of really holding up, again, the baton for world growth, right? The idea that the U.S. avoids a recession, definitely good news for the rest of the global economy, but then added to that, of course, the China reopening reopening, I mean, we've definitely seen any economy that's coming out of lockdown really get that bounce. And I think that could be quite a powerful catalyst, or at least a cushion for world growth, given that 2023 is going to be a challenging year. And as Mira pointed out, I think that's going to be particularly good news for Europe, given that it is quite levered to the Chinese growth story as well.
Mira, what's the most interesting currency right now? I mean, yen, although sterling is certainly not dull.
Oh, no, none of them is dull right now. That's the one thing we can say about currency markets. They're not doing what one might expect, but it's not far from dull. Look, I think yen is super interesting because the BOJ is on a path of policy normalization that will unfold over a multi-quarter period. We're not done with it yet. We expect another shift in yield curve control by mid-year this year. They come out of negative interest rates next year. So there is a path here for policy normalization, whereas the Fed is actually going to be slowing and staying on hold for a long period of time. So the expectation is actually that dollar yen should continue to weaken over a multi-quarter period. You know, we're thinking probably the low 120s is not unreasonable.
Yeah, for yen, is there a danger again that the market is already pricing everything in before we even have the appointment of a new central bank governor?
I don't think it is. It is, you know, if you look at the way dollar yen's moved, it's perfectly explained by the changes in U.S. yields and changes in Japan yields. And I think if we expect more of a convergence there, I think there is more space here, particularly if you're talking about U.S. recession risks as well. I mean, the dollar tends to weaken versus other reserve currencies in that kind of scenario.
Yeah, and there's plenty of things going on, of course, with the Bank of England, so that's Thursday, and then we had this pretty incredible piece from Bloomberg Economics saying the UK economy is losing £100 billion because of Brexit.
Absolutely, Francine. I mean, when you look at it really, the IMF report, the cost of Brexit, the UK is really quite the laggard in a lot of ways, right? And we know that the reasons why is just because it's battling this cost of living crisis, the cost of Brexit, and of course we have just labor strife as well that's currently going on with all the strikes. And so it really is quite a challenged position. You can understand why the IMF thinks this is going to be the only major economy hitting a recession this year.
Yeah, what does this mean for sterling?
It's not good. Recessions are never good, particularly when your major trading partners, such as the Eurozone, now looks like it's going to be avoiding a recession. And I think the key issue with the UK is that labor markets are incredibly tight. The supply side measures are incredibly constrained. And as you said, the growth picture is probably the most lagging of any other European economy. So from a fundamental standpoint, we are underweight sterling, looking for it to underperform euro. The only thing is, yeah, in the near term, this is, you know, this does benefit from the general optimism that Europe is going through right now, but I think the fundamentals are actually quite weak.
Mira, thank you so much for joining us. Mira Chandan, JP Morgan co-head of Global FX Strategy, and Bloomberg's Christine Aquino. Coming up, more economic data out of the Eurozone, including the latest inflation print and GDP numbers ahead. Implications for ECB's decision on Thursday? Well, there are plenty of implications, so we'll discuss those next. And this is Bloomberg.
Typically, between the time you start and they get out in the farmers' fields, is about 8 years. Now, we have a pipeline of innovations. You know, we've been funding the CG system for 20 years now. It's funded at about $1 billion a year. If people care at all about adaptation, that thing will be funded at $2 billion a year. I mean, there won't be anything close to the impact of climate-related seeds, climate-related maize, rice, wheat, sorghum, millet. And thank goodness, because of human genetics, we know how to do the editing. Thank goodness because of AI, we know how to find the alleles. Because of drones, we can measure stuff in the field. So there's huge advance in terms of how the whole seed ecosystem moves at full speed.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
A slew of economic data today ahead of the ECB decision on Thursday. In France, inflation came in at 7% in the year to January as the economy grew 0.1% the fourth quarter. We're also just minutes away from the CPI print for the wider euro area. Joining us now, Europe correspondent Maria Tadeo in Brussels. So, Maria, good morning. What are the French readings actually telling us?
Yes, Francine, and a lot of data coming today, kicking off with the French economy. You did see growth in the final quarter of the year, 0.1%. They avoided, therefore, a contraction. Of course, it's now fireworks growth, but if you compare it to Germany yesterday, there's some relief there. On the inflation picture, you've had on an annual basis, inflation accelerating 7%. But of course, again, this is a general theme across the euro area. This has to do with the energy story. It was a very challenging year for all the reasons that we've talked about on the show repeatedly in 2022. However, going forward, there are two big question marks when you look at the French economy. One is definitely the strikes. The French president, Emmanuel Macron, has made it clear he wants to get this pension reform going. He wants to get it done, but that means more strike action. Today, we're expecting some more. And then when it comes to inflation, I think it's already made very clear by the French finance minister. You spoke with him in Davos that the idea of let's subsidize everything, let's pay for this is cushion the impact. The government wants to be more targeted in 2023, so that could in some ways accelerate inflation even more.
So what does all this economic data mean for the ECB decision on Thursday, Maria?
Well, Francine, overall, if you look at the inflation print today in France, if you look at the inflation print in Spain yesterday, which was a blowout number, although we should always clarify that Spanish inflation, it gets treated differently. The methodology changed yesterday, so treat that number carefully. But overall, it does point to inflation that continues to be way above target. And if you look at the language from Madame Lagarde in the past 2 months, essentially, she's repeated, we're not done yet. The central bank's single mandate is to bring it back to target. On Thursday, the market has fully priced in 50 basis points hike. The real debate is March, but given the data here, you could argue the hawks will make a case that inflation is not over. This is not hit and remove. This is hit and stay the course, so pave the way for another 50 basis points in March. That's a real debate.
Maria, thanks so much. Our Bloomberg Europe correspondent, Maria Tadeo. Coming up, Brexit costing the UK £100 billion a year. That's the finding of new Bloomberg analysis 3 years after Britain left the EU. More on that next. This is Bloomberg.
does everybody want to be a consultant, and what are all these consultants doing?
Well, David, I think that we actually defy the label consultant, because sometimes consultant seems to imply that we only give advice. And when you look at what Accenture does, we're really different than the traditional version of a consultant. We're really about relevance and results, and that's what is driving our business.
What about a consulting project? In my example, I'm the CEO, I have a problem, I call you up, I say, solve my problem or give me a solution.
We don't operate as big companies permanently in crisis mode. And so when you think about like how long does it solve things, a lot of it starts with, you know, the company being willing to set aggressive goals. And so what we are trying to do now is work with our clients to work differently and to work faster.
Growth forecasts are increasing and inflation is falling. Will the European Central Bank make its fifth rate hike in a row? How high do rates need to go? Bloomberg Television and Radio brings you the breaking news from Frankfurt and detailed analysis after ECB President Christine Lagarde's press conference.
The central banks, and certainly the ECB is pushing this line, have got much more wood to chop. They've got much further to go.
Coverage begins Thursday, only on Bloomberg, your global business authority.
The IMF forecasts that the UK will be the only G7 country in recession this year and will have the slowest growth of its peers in 2024. This comes as Bloomberg Economics reports that Brexit is costing the UK economy £100 billion a year. For more, we're joined by Bloomberg's Dan Hansen, who, of course, is one of the authors of this report. Dan, what more did the IMF have to say on the UK economy?
So I thought the IMF forecast was pretty interesting, actually. I mean, it's brought its projection further in line with what we're thinking about the UK at the moment. So we think there will be a recession in the first half of this year. We're a little bit more optimistic about how much output will fall in 2023 than the IMF. So we've got a 0.4% contraction. The IMF have got a 0.6% contraction. But I think actually what's really interesting, and it sort of plays into the Brexit story here as well, is how weak the recovery is moving into 2024. So the IMF have got 0.9%. We're more pessimistic than that, in fact. We think the economy will only grow by 0.5% in 2024. So we've got this very weak 2 years where the broad story is one of stagnation for the UK.
So, Dan, this also big piece of analysis that you did at Bloomberg paints this gloomy picture for the UK economy regarding the hit from Brexit. What have you found?
So we looked at sort of the impact of Brexit through a number of angles. There's the sort of classic angle, just looking at the headline impact on GDP, and that's the number you've said there, this £100 billion number, which is essentially that we think the economy is about 4% smaller than it otherwise would have been had it remained in the single market. And we've looked at other angles as well, so the impact on investment, which is well known, the impact on uncertainty has come through and really damaged investment in the UK. Trade as well is a little bit weaker, though it's not quite as weak as we would have expected. You'd expect that to be one of the key channels through which Brexit affects the economy. And of course, migration as well. So we've had migration has been weaker, certainly from EU migrants. EU employment is weaker than the trend going into the point at which the UK left the single market. And I think the broad story, the broad takeaway from this is that the impact of Brexit has come through far quicker than we'd expected. So most forecasters, including ourselves, expected a sort of slow burn shock, if you like, something that affects the economy but over quite a long period of time. But actually, these numbers suggest that it's come through quite a bit quicker. And the risk is that there's more to come, of course. So that's the sort of key takeaway from what we found. And yeah, that note is on the terminal this morning.
Dan, I mean, you basically argue that the economy is 4% smaller than it might have been otherwise. Are there any steps that they can do now to reduce that shock?
Yeah, I mean, that's a really good question. I mean, I think what the problem the government's had, and there is definitely some sympathy here, is that you've experienced these two enormous shocks in the interim. So you've had Brexit going on in the background, but we've had the pandemic, and of course we've had this enormous energy shock as well. So there are these two shocks that the government is having to fight. And I think what's really important now is that the attention turns to sort of making Brexit work. And this analysis that we've put out, it demonstrates that there's quite a long way to go to make things better. And I think the challenge here is that when you leave, you change your relationship with your biggest trading partner, which is the EU, and a frictionless agreement you have with the EU. You have to try and replicate and sort of make up for that in other places. So it is really important that other trade deals are forged in time. But the question really there is whether they can truly compensate. And I think from where we sit, the net effect of this is going to be negative for the economy. But there are, as I say, there are steps the government can take, and it is really sort of trying to find ways of compensating for the loss of access to the single market.
Dan, thank you so much. Dan Hansen with the very latest on this very important Bloomberg economics piece. We'll be covering all things UK every week on Thursdays at 9:30 a.m. in our half-an-hour special. A reminder, this Thursday, it's also Bank of England Day. Let's get straight to the Bloomberg First Word News. Here's Leanne Gearens. Hi, Leanne.
Hi, Francine. French labour unions are leading a second day of mass strikes and protests against government plans to raise the retirement age. The country's rail operator, SNCF, predicts only 1/3 of high-speed trains will run and urge people to actually work from home. Widespread disruption is expected on the Paris subway, with many schools also closed. The International Monetary Fund has raised its global economic growth outlook for the first time in a year. It now sees GDP expanding 2.9% in 2023, 0.2 percentage points more than in its October forecast. The IMF says resilient US spending and China reopening will help shore up demand. And a bomb attack on a mosque has killed more than 70 people in northwestern Pakistan, leaving more than 150 others wounded. The blast happened during afternoon prayers close to Peshawar's police headquarters and other government offices. It's Pakistan's worst such attack in almost 11 months. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gearens. This is Bloomberg. Francine.
Leanne, thank you. Coming up, it could be no way for Huawei. That says the Biden administration was cutting the Chinese firm off from U.S. tech supplies. More on that story next. This is Bloomberg.
We're investing in a lot of different capabilities and features that makes the in-store shopping experience that much easier, that much more compelling, whether it's price check, browsing inventory in this store, so that we can really make that experience as convenient and as simple as possible.
Convenient, simple, that's sort of what people have needed in the age of COVID. Is that here to stay, or do we go back when finally we all hope that the pandemic will be behind us in some way? Do our changing shopping habits go back again?
What's really interesting about retail in my 20-plus experience is that convenience never reverts itself. Now, the form of convenience has shifted, whereas, say, in 2000 to 2010, a lot of convenience was driven by more stores nearby. Now it's stores in addition to digital. There's nothing closer than the phone in your hand.
In London, in Sydney,
from Washington,
in Tokyo.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
Here's what I'm watching.
You do not want to miss this
Is
story.
there the kind of upside?
The IMF raises its global economic outlook for the first time in a year, but it predicts the UK will be the only G7 member in recession in 2023. France unexpectedly grows in the fourth quarter. GDP rose 0.1%, boosted by investment and net trade. We turn our attention to the wider euro area figures due later. And UBS tops estimates and announces a more than $5 billion share buyback. The chief executive, Ralph Hammers, says shareholder returns are an important part of the business strategy.
If we can grow, we will grow, if that will cost some capital as well. But then it's all about attractive progressive dividend and a share buyback. And we have confidence that we can buy back over $5 billion in this year.
Good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacroix here in London. The Biden administration is said to be considering a full ban on Huawei from U.S. tech suppliers. The move would mark a notable escalation since former President Trump placed limits on imports from the Chinese tech company 4 years ago. For more, we're joined by Bloomberg's Debbie Wu from Taipei. Debbie, good morning and good afternoon. If this ban happens, chip makers like Intel and Qualcomm will be directly impacted. So what does it mean for the companies involved?
So for American companies that's still supplying to Huawei, the impact they're going to feel probably is going to be relatively modest because after the Trump administration sanctioned Huawei in 2020, American firms have not been able to ship most of their products to Huawei anyways, particularly the most advanced chips. But on the other hand, for Huawei and China, which continue to want to export their technology overseas, this could come as quite bad news because Huawei will not be able to get chips for its products ranging from PCs and smartphones, and probably its core networking products will be affected as well. And this really would affect their performances and also their ambition to expand their technology influences globally.
Debbie, if this does happen, does this mean geopolitically that actually the U.S. is picking a fight with China right at a juncture where we thought they were getting along better?
Actually, what we have seen over the past month is that the U.S. is working aggressively to make sure that it is containing China when it comes to China's technology development. We have seen the U.S. reaching a agreement with the Netherlands and Japan to limit the exports of advanced machinery to China for chip making. And now we are seeing that the U.S. is trying to further restrict Chinese companies' access to advanced chips. So all the signs are pointing to the fact that the technology war between the U.S. and China are intensifying.
Debbie, thanks so much. Debbie Wu with the very latest on some of, well, the story from Huawei. PM data from China also shows manufacturing and services expanded for the first time in 4 months in January as a reopening from COVID-0 continued and the Lunar New Year holiday spurred travel and spending. We're now joined by Phoenix Callan, a global head of emerging market research at Societe Generale. Phoenix, as always, thanks so much for coming on. How do you see the China reopening impacting inflation worldwide?
Yeah, so I think for the inflation picture, the China reopening is going to be very supportive for commodities generally. For oil, we are expecting to see an average price of around $100 per barrel this year, with the potential for that to reach $110 per barrel if there's upside growth potential out of China above what we're forecasting, which is around 5.3% GDP growth for this year. So if there is further impetus on the upside, we can see much more potential for oil prices to be higher. We think China should also import more LNG, and that could put more pressure on gas prices. And of course, there's the positive sentiment out of the copper market, and that's going to be significant as well. So the commodity complex is likely to put further upward pressure on inflation. I think overall, though, in terms of the impact on inflation spillovers, that is likely to be quite notable for the energy and upstream materials markets. But on the other hand, the impact on CPI on the US or on the euro area out of China reopening is probably going to be not very significant, not significant enough for the central banks there to alter their monetary policy paths.
So, Phoenix, would you say it's actually a welcome boost for, of course, China, but also world growth?
Yes, absolutely. I think the China reopening narrative has really re-energized the kind of investment thesis into emerging markets. And we have seen kind of the incremental inflows start to come back into EM after 3 or 4 years of investors kind of diverting away from the asset class. And we've seen lots of inflows pick up in January. And that is likely to improve now that we've got potentially a much greater growth differential between emerging markets and DM for this year. And I think the lingering concerns around whether or not there's going to be another sell-off in U.S. rates, back up in the long end, those fears have receded to a large extent. They've been replaced, of course, by fears around the extent of the U.S. slowdown. But overall, I think the pressures that come out of the rate cycle from the U.S. is much less on emerging markets. And with yield levels, with currency valuations being a bit more attractive than they were historically, there is still room for investors to start to come back in.
Phoenix, what emerging markets will benefit the most from this? So is it some of the neighboring countries? Could it be Australia? So do we keep it in Asia, or could it also benefit further afield South America?
Yeah, so we think in terms of the main beneficiaries, of course, of the China reopening, that is going to be some of the regional players. We'll see, out of China tourism, that is going to benefit a lot. Thailand, Hong Kong, Macau, Australia should benefit as well. I think more broadly, because of the support to the commodities complex, that is going to be quite supportive for the LATAM FX in particular. So we are long things like a basket of LATAM FX, including BRL and MEX versus CNH, for instance. So we think the high yielders will still stand to benefit greatly. So LATAM, RAND versus some of the low yielding markets and versus CNY.
Phoenix, when you look at Brazil, I know it's a tough balancing act, especially the fact that we're still trying to really understand, I guess, what the new government stands for. Where do you see opportunities?
Yeah, so we've seen a bit of a back and forth and kind of an own goal happening in Brazil with respect to the president coming out a couple of weeks ago and making statements that appeared to undermine kind of the central bank's independence and their inflation targeting mandate. And we've seen some of the policymakers kind of try to step back from that and walk back some of those comments last week. And so there have been a lot of volatility in the BRL on the back of that, and on the back of still lingering concerns around what the ultimate cabinet will look like and the policies that they will administer going forward, and how radical those policies might be. So the fiscal consolidation trajectory is still a question mark. I think overall, though, given how undervalued BRL is in real effective exchange rate terms, long run averages, and the kind of growth potential that there is there coming out of the commodity cycle and out of a China reboost, then I think there is still potential for upside in the BRL story.
So if you look at, and I know you've zoomed in on Chile, Colombia, and Mexico, is there more upside on the Mexican currency?
So MEX is certainly not one of the undervalued currencies. It has performed very strongly over the past several years. It's really kind of suffered more recently with respect to the China reopening, where other currencies in LATAM were more favored, and the kind of the traditional long MEX versus other LATAM play petered out more recently. Because MEX was more traditionally seen as kind of this safe haven within LATAM. I think MEX can still perform in terms of the more balanced macroeconomics and the fewer kind of economic imbalances that they have in their economy. That can still support MEX as well as from the carrier's perspective. So I think the gains in MEX can be more limited versus other LATAM currencies, but we would still favor being long MEX.
Phoenix, is there something at the moment that seems unnerving? We talk a lot about liquidity. We talk a lot about also default rates, given the pace at which interest rates went higher in the last 12 months. Is there a particularly vulnerable part of the market for emerging markets right now?
Well, so I think it's not all rosy. We have seen valuations come back dramatically. I mean, we've seen, EM currencies appreciating 6% in the space of 3 months. In terms of valuations, it's not as attractive as it was 3 months ago by any means. We've seen, of course, a huge drop in the dollar index, for instance, and how far that trade has reversed. So it's reversed close to 40% of the move up over the past 2 years. Just within the past 3 months, it's caused that reversal. So I think valuations is a source of concern, and on the other, and also fundamentally, the growth outlook is improving, but it's not spectacular. So the manufacturing PMIs, for instance, are pointing to still some decelerations, very marked decelerations out of the developed markets, and kind of more stagnation out of the emerging markets. So I think both the direction of travel and the starting point of travel on the manufacturing side are causes of concern. So the growth picture is not overwhelmingly spectacular, and that still is going to be a source of worry for investors looking for places to invest this year. I think, overall, with valuations still slightly attractive, and the growth overall improving as we come out of the pandemic and as the war worries start to fade, then there is some upside for emerging markets to attract some of that interest.
Phoenix, thank you so much. Phoenix Callan, Global Head of Emerging Market Research at Societe Generale. Coming up, a big bank beat and $5 billion in buybacks. We'll hear more from the UBS Chief Executive next. This is Bloomberg.
A book about YouTube now. Why'd you do this project?
Yeah, YouTube is this kind of a sleeping giant in social media. Someone described it as like this iceberg that no one ever really talks about as much for a variety of reasons. I see YouTube as both the past and now future of social media, and it was the first company to pay online broadcasters and invented the creator economy. And now we're seeing with TikTok, Instagram, Snapchat, are all moving in this direction. Social media is no longer your friends and family and your acquaintances. It is influencers. It is celebrity. It is a game built around commerce. And this is a world that YouTube very much created.
Should we be telling Odd Lots listeners to like, comment, and subscribe? Other podcasts do that.
I mean, it's an effective call to action.
All right, everyone, like, comment, and subscribe on Odd Lots wherever you find it.
Why is it that whenever there is like a scare coming along or a pandemic or something, people rush to buy toilet paper? Have you ever noticed that? People are just, they're stockpiling toilet paper.
It's
Is that
called hoarding,
hoarding?
and
Okay.
it's one of those things you never want to be without.
Some breaking news, one of our top stories, of course, that we've been following very closely for the whole week. Adani Enterprises, the share sale of $2.5 billion has been fully subscribed. There were many questions about whether this would be subscribed. We did see some of the royals in the UAE taking a chunk. This is the very latest news coming across the Bloomberg terminal. It has now been fully subscribed. This does not mean overall that the share price will rise in the next couple of days, but certainly for the moment, a bit of reprieve for Adani Enterprises that has gone through a massive shift. I think some $75 billion have been lost in market value. UBS fourth quarter profit beat expectations and said it's planning a share buyback of more than $5 billion this year. That's as rising interest rates helped offset a slump in trading fees as the key wealth management business. Bloomberg's Manus Krani spoke to the UBS chief executive, Ralph Hammers.
Indeed, we had a very good set of numbers in the fourth quarter, and not only on the income side, but specifically also on the underlying flow side. 23 billion of net new fee-generating assets, 11 billion of net new money, 9 billion of net new deposits, basically showing the trust of our customers to basically place the money with us and for us to help them manage it. On the back of that, clearly with lower market values on the fee income, that was a bit lower, but the interest income really came through. It is very much the dollar effect and the Swiss franc effect now as well. On the dollar effect, we feel most likely peaked. However, there is more to come on euro and certainly also on the Swiss franc.
Just on those central banks, we caught up 2 weeks ago, and there was the feeling that maybe we're near the top of these central banks in terms of the hiking cycle, specifically the Fed. Paul Krugman joined us yesterday and he said, be careful. Stop getting over your skis and overconfident on inflation. Are you overconfident that we've peaked on inflation?
We may have peaked on inflation, but it doesn't mean that the central banks will not further increase some rates, just to be sure. I do think that they are very clear in terms of what they want to achieve. They really want to get the structural inflation down. And that could come along with a real deceleration of economic growth. I think the recipe is that we rather have a short-term pain with a long-term gain than not being tough enough in order to get that inflation back to that level. And that is what I think central banks have in their minds.
In the fourth quarter, you've had some short-term pain. The fees were down 17%, transactions were down 19%. Is that the worst? Is that the nadir of the sidelining of wealth management clients?
Well, if you look at the different components on the wealth management side, so first, what is important is that you see that the trust is there and that clients come to you. That basically shows that we have the right professional services, we have the right products, we have the right advice, we can take them through a period of challenges and unclarity. That period of unclarity is still there, right? So we see positive news coming from China, we see positive news coming on also inflation. We see some life back in the leveraged capital markets, which is normally a leading indicator. However, all early movements. So I don't think there is a trend there yet. So for the moment, I do think that our clients are hopeful, but in a wait-and-see pattern.
Well, there has been a move to risk on assets. This is the debate. We're 1 month in. There's been a move to risk on assets. You use the word sideline for wealth management clients in the fourth quarter. Are they nibbling? Are they active in acquiring risk on assets?
That's not what we see. We truly see that they are waiting for more clarity to come. And I think that's wise. We really want to make sure that there is more visibility. I do think that the coming weeks will bring that more visibility. We'll see there are central banks coming to the market. We see the New Year's, the Chinese New Year's behind us, and see whether the positivism coming from China will continue. We see corporate earnings coming through in the next couple of weeks as well. So I think the next couple of weeks from different sides will give us much more data points to get a feel for should we be risk on or not.
Fit or kill on risk on in the next couple of months. The other aspect for me is the re-leveraging. Every time we get together, you say deleveraging in Asia, deleveraging. Is 2023 going to be the year of re-leveraging given the boom, the sort of the mini boost that we've had from China?
Well, it really depends. So if the investor confidence is there and they are going to go risk on, our investors and our advice will always be, okay, what does leverage cost you? Because you should realize that vis-a-vis the last decade with very low rates, leverage was almost free. Leverage going forward is not almost free. It will come at a cost. So that will be a different perspective in terms of taking on further leverage or not. We do expect at a certain moment that to turn and leverage to come back into the market. In Asia, we've seen more towards the end of the fourth quarter. We've seen some stopping of the deleveraging there. But it's too early to tell whether that's a trend.
UBS Chief Executive Ralph Hamers speaking to our Manus Cranny. Coming up, Ford in Europe, we hear more on how the car maker is handling economic headwinds and cutting its latest EV prices to rival Tesla. This is Bloomberg.
Typically, between the time you start and they get out in the farmers' fields, is about 8 years. Now, we have a pipeline of innovations. We've been funding the CG system for 20 years now. It's funded at about $1 billion a year. If people care at all about adaptation, that thing will be funded at $2 billion a year. I mean, there won't be anything close to the impact of climate-related seeds, climate-related maize, rice, wheat, sorghum, millet. And thank goodness, because of human genetics, we know how to do the editing. Thank goodness, because of AI, we know how to find the alleles. Because of drones, we can measure stuff in the field. So there's huge advance in terms of how the whole seed ecosystem moves at full speed.
You've got to explain this one to me. What does it mean when the White House says we're watching markets carefully?
It means they have a Bloomberg.
I've seen the Bloomberg.
They have.
I've been in and seen it.
Lots of Bloombergs. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg.
I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. What does it mean? What does it mean? What does it mean? What does it mean? What does it mean?
It means they have a Bloomberg.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
Ford recently announced about 3,200 job cuts in Europe to be centered in Germany. That's as the car maker slashes costs to help finance its electrification plans. Bloomberg's Ollie Crook sat down with the company's Model E general manager.
The technology we are using in terms of customer expectation, everything is changing, but it's also extremely exciting because we basically can build a new business. Yeah, our plan is by 2030 to have 100% of our passenger vehicles in Europe being battery electric, and by 2035 all our product range for Ford in Europe will be battery electric. And not only that, but also our whole industrial footprint will be carbon neutral by 2035. You can imagine a huge amount of investment and change has to go in to make the plant, the logistics, and suppliers to take everyone along on this journey.
It's expensive, it's complicated, there's a lot that goes into it. What are you focused right now on cracking in this transitional period at this point in time?
As you see, it's a huge transition, it's a huge investment, it's a huge project to turn a traditional car company, a traditional production site into a very modern production site. And getting the whole team on board, making the whole team aware of the changes, building the confidence in what the company can actually achieve in these exciting times, that I think is a big task and a great challenge.
And these exciting times, also challenging times in some ways. You know, inflation has been the word of the moment for a while now. A lot of the inputs and the issues going on there. As we shift into an electric world, where there are some ways in which we're much more sensitive to very specific inputs, namely batteries and chips. How do you insulate yourself to those kinds of vulnerabilities?
In general, when it comes to semiconductors, we see the challenges of the last years ease, so supply is clearly picking up. When it comes to the overall resources, I think we need to have a solid plan. We need to have a clear plan on where we want to go in terms of product lineup, in terms of production, and then make sure that we understand the overall supply chain and lock in all the contracts and make sure that we have supply to all the materials we need to put our growth plan into action.
And on the subject of inflation, where do you see costs still being pushed up, and where do you feel that it's gotten better? It sounds like chips, it's improved somewhat. Is that across the board, or are there still places where there's some persistent issues with cost?
In general, we see costs coming down, maybe not to normal levels. Also, energy costs, of course, still higher than a couple of years ago. But overall, we see the cost pressure coming back from the challenges we've seen maybe half a year ago.
That was Bloomberg's Ollie Crook with Ford Model E General Manager Martin Sander. This is a picture for banks across the board. So we had 3 banks that beat earnings. UBS share price, so a bit under pressure. We had that great report for our Manus Cranny, who also caught up with the chief executive over in Zurich. Now, the key takeaways from UBS's fourth quarter earnings, the chief executive officer wants to keep delivering returns of capital. A bit of concern, so they beat earnings, but a bit of concern about some of the wealth management units going forward. UniCredit giving more back to shareholders, that share price gaining 8%. Bloomberg Surveillance Early Edition continues in the next hour. This is Bloomberg.
So the inflation environment has been changing a little bit. Inflation's been very low for 25 years. Now people think inflation's coming back. How are you going to deal with that?
I
I think many of the tools that we've historically used to battle inflation no longer work in the same ways they used to. I think people oftentimes thought of housing as a way, or especially retail and real estate as a way to hedge against inflation. Less and less possible the way we've invested in it. I think commodities similarly have been thought of as a way to hedge against inflation. There are challenges over the long term. Equities have been a hedge against inflation. We will continue to do what we have done in the past, which is build a diversified portfolio where there are many different opportunities that have the possibility of hedging against inflation, because different types of inflation have to be hedged in different ways. So if it's a very quick increase of inflation as opposed to a slow rise of inflation, is it temporary? Is it a long or persistent type of inflation? So for us, I never model myself an economist that can predict where inflation is going. And so what I need to do is build a diversified portfolio where there are different options that can fight the different types of inflation, and to pay close attention to it. And you know, fundamentally, it's done through the equity markets.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Welcome back to Bloomberg Daybreak Europe.
Good morning, good morning. This is Bloomberg Surveillance.
Welcome to Bloomberg Markets, trying to open.
This is Bloomberg Technology.
To our television and radio audiences worldwide, welcome now to Balance of Power. This is Bloomberg.
This is Bloomberg.
Core inflation measures have shown more persistent, and they have not peaked yet in many countries, and they are still far away from central bank targets.
We may have peaked on inflation, but it doesn't mean that the central banks will not further increase some rates.
The problem is beyond inflation. The problem is the structure of the modern world in which we live.
This is Bloomberg Surveillance, Early Edition, with Anna Edwards, Matt Miller, and Kaylee Lines.
It is 10 a.m. in London, 5 a.m. in New York, 6 p.m. in Hong Kong. Our top stories today. UBS does better than expected in the fourth quarter and will buy back more than $5 billion worth of shares. Rising interest rates helped offset a slump in trading fees and transaction income. The IMF sees a turning point in the global economy. For the first time in a year, the fund raises its growth outlook, and the sell-off at Adani Group has wiped off $75 billion in market value, but the flagship's $2.5 billion equity sale is now fully subscribed on its final day. Welcome to Bloomberg Surveillance, the early edition. I'm Matt Miller with Kaylee Lines here in New York. Anna Edwards is off today. Kaylee, we're seeing a little bit of a drop in markets across Europe after a lackluster day in the U.S., to say the least. What are you seeing in terms of Asia?
Well, happy last day of January, Matt. And yes, it does look like we're going to end it on a down note, but we have to keep in mind that it has been a fairly good month for equity markets really around the world. That definitely is the case when it comes to benchmarks in Asia. The MSCI Asia Pacific Index ending January 7.7% higher than it started it, but it did end it with a down day. The MSCI Asia Pacific Index down more than 1% overnight. Even stocks down in China by 1%, despite the fact that we got better than expected economic data. Manufacturing and services PMI for January back in expansion territory, which of course is delineated by that 50 mark. Manufacturing coming in at 50.1, services beating estimates at 54.4, but that not enough to fuel risk sentiment in Chinese equities. As for some individual equity stories to note from Asia, one of them being Samsung. The stock was down 3.6% in South Korea after it reported earnings. Profit in its chip division fell 97%, and analysts and investors seem to be disappointed today that despite clearly the fact chip demand is waning. The company did not announce plans to cut CapEx. Then, of course, the other stocks we continue to watch are those related to Adani Group. You're seeing some of them, like Adani Total Gas, still losing value today. Adani Enterprises, though, the flagship, up 1.9%. As you said, Matt, that $2.5 billion share sale now is fully subscribed.
All right, we'll continue to follow the Adani Hindenburg story, of course. Meanwhile, in Europe, we had the economy growing 0.1% quarter over quarter. In the fourth quarter, the estimate was for a drop of 0.1%. So better than expected in terms of the overall euro area. We're getting different individual countries reports out as well. But the stock 600 is down right now, about 0.75%. This despite the gains that we're seeing in most of the banks over there. You can see investors are buying the Bund right now, pushing the German 10-year yield down to 2.301%. One bank in particular, UBS, which I talked about at the top, and we're going to focus in on with its $5 billion buyback, did have a slump in trading revenue and transaction fees. As a result, those shares are down 3.5%. But UniCredit, I think, is a better representative of what we're seeing in a number of other banks across Europe. SEB, for example, and Swedbank, all gaining. UniCredit right now up more than 8%. Meanwhile, here in the U.S., after a drop in the cash trade of 1.3% at the close yesterday, we're looking at a drop in futures again of 1/3%. Now, as Kaylee pointed out, it's been a pretty good month. I think we're up about 4.6% on the S&P 500 so far this year to date. But we do look like we're going to end the month lower. The U.S. 10-year yield also coming down as investors buy those bonds. 352.53 is the level there, out 5 significant digits. And the Bloomberg U.S. Dollar Index jumping up again for the third day in a row now at 1227.77. Finally, NYMEX crude as well as Brent falling today. West Texas Intermediate trading for 76.61 a barrel. Kaylee?
All right, Matt, well, let's get back to the European data we mentioned. Bloomberg Markets reporter Valerie Teitel is joining us with the latest. So, Valerie, we've seen some hot inflation from the likes of Spain yesterday, but we also are seeing better than expected growth in the euro area and certain countries within it. How does this change the dial for the ECB?
Well, the bond market surely took a breath of relief after the French inflation number came in line, but it still muddies the picture on what exactly is going on in Europe in terms of inflation. Can we say now that maybe headline inflation hasn't peaked? And to add to that confusion, Kaylee, Germany is in the midst of changing the way that they collect their inflation data, and they've actually delayed their inflation prints until next week, which is concerning if you're the ECB and you meet this Thursday. Eurostat has said that they're going to use an estimate for the German number in the euro area print that we get tomorrow. But look, let's not take our eye off the ball here. Core inflation is really what we care about, and we don't really get this breakdown when it comes to the national prints. But given the German number won't really be involved in this core inflation print tomorrow, can we really trust it? Can Lagarde really trust it on Thursday? And given that, would you really be certain in giving us any guidance on how many is in a series? How many 50 basis point hikes can we expect from the ECB? The market is currently pricing 2. But with this overshadowed estimate on the German number, perhaps we have to wait until March when we get their upgraded economic growth forecast to see what they really think.
Valerie, speaking of growth forecasts, the IMF upgraded its growth outlook for the first time in a year. What drove that revision?
Yeah, Matt, the two things that drove that revision were the more resilient U.S. consumer and the fact that China was reopening quicker than expected. But I want to say that these IMF forecasts is part of a quarterly review that they do. And if anything, it just marks a shift in tone. The IMF all last year was really warning of a global economic slowdown, and they've clearly turned the corner on picturing growth being more rosy as we go forward.
All right, Valerie, thanks, Valerie Teitel there. Taking a look at the European data and the revisions that we saw from the IMF. Now, UBS reported fourth quarter profit that beat expectations. The Swiss bank plans to buy back more than $5 billion of its shares this year. The CEO, Ralph Hammers, spoke to Manus Craney earlier.
If we can grow, we will grow, if that will cost some capital as well. But then it's all about attractive progressive dividend and a share buyback, and we have confidence that we can buy back over $5 billion in this year.
Manus Crane joins us now from Zurich. So, Manus, the stock is down this morning. Is that all because of the slump that we saw in trading revenue and transaction fees?
Look, definitely, if we look backwards, Matt, fees and transactions down double digits, 17 and 18% respectively. I think where the disappointment comes is there's so much hope, but just very little conviction between the caution from the client and that caution morphing into the courage to actually take on risk asset. I had this debate with a friend in Dubai before I left. I said, look at Tesla, it's up from like $104 to $180. He went, Manny, he said, that is not risk on. He said, that's just risk recovery and short covering. So I think therein lies the problem. They're seeing a minute level of deleveraging stopping in Asia. In other words, that deleverage that we see every quarter when we sit down with Ralph, that seems to have tailed off in the back quarter, just as that China reopening story came out. The question in terms of fill or kill, to quote the market order, in terms of getting those clients to actually move risk on, buy assets, and move from high-yielding certificates and deposits into active embracing of risk is the magic potion that will deliver the upside. By the way, the $1.65 billion of net income attributable to shareholders, what a mouthful. 35% of that came from interest rate booms. The question is, does that hold through 2023? Kaylee.
All right, Manus Crane in Zurich. Great interview. Thank you so much. Let's turn now to Adani Group, and the record $2.5 billion share sale by his flagship company has been fully subscribed on the final day. The feat offers Asia's richest man a reprieve after his empire was rocked by allegations of fraud by short seller Hindenburg Research. Bloomberg's PR Sanjay joins us now from Mumbai with more. So we're now fully subscribed, but Sanjay, PR, that doesn't mean that this saga is over.
Oh, the saga is definitely not over, because one simple research which alleged, corruption, money laundering has taken Asia's richest man from the top, world's top richest list, and it is also wiped off around over $17 billion of Adani conglomerate, the port to power conglomerate. And now what we are hearing after yesterday, IHC have given a vote of confidence by investing $400 million into the FPO, the follow-on offer. There are many, companies, many high-profile investors invested in the FPO. We understand the high-profile Indian corporates have also invested in this FPO, and the retail investors are still, it's not, that's very poor, but there are a few more hours to go to conclude this so-called India's largest fall-on share sale by Adani Group. So one will have to wait and watch whether it will be oversubscribed or not. But however, now after a lot of struggle, it is fully subscribed at this point of time.
Yeah, and we'll definitely continue to keep a close eye on this continuing saga. PR, thanks so much for your reporting. PR Sanjay there from Mumbai. Now, let's get to the auto industry. Ford recently announced 3,200 job cuts in Europe to be centered in on Germany as the car maker slashes costs to help finance its electrification plans. Bloomberg's Oliver Crook joins us now from a Ford factory in Cologne. So, Oliver, what is Ford doing there, and how does it fit into the broader strategy and to the economic picture?
So, Matt, we're here in Cologne, this massive production site here for Ford, and as you can see, all these cars behind us, these are all combustion engine cars. And this is really a moment of transition for the auto industry, and this really serves as a nice symbol for that. This factory is being converted into an EV manufacturing site. They'll have EVs rolling off the assembly line by the end of this year. They want every car in this parking lot by 2030 to be an electric vehicle, and they're spending big to do that. $2 billion is going into that here in Europe. I spoke to Martin Zander. He's the man in charge of the electrification push here in Europe, and it comes at a time when you have costs coming up and you have supply chain issues and inflation, as we've been talking about this morning. Here's what he had to say about costs.
In general, when it comes to semiconductors, we see the challenges of the last years eased, so supply is clearly picking up. In general, we see costs coming down, maybe not to normal levels. Also, energy costs, of course, still higher than a couple of years ago. But overall, we see the cost pressure coming back from the challenges we've seen maybe half a year ago.
So maybe not in Spain, but costs coming down, at least in the manufacturing sector here in Germany.
All right, well, let's talk about, as we talk about costs and price, The price of a Mustang Mach-E, which Ford announced yesterday it was cutting. What does it tell us about A, the company's transition to electric vehicles, and B, whether or not we're going to get an all-out price war among Ford and its competitors?
Well, it tells you a lot about competition right now in the EV sector. This is a sector that, you know, in some ways was ruled by Tesla, had a lot of power over the market, and now basically this is a reaction to the Tesla price cut. And you're in a situation now where you have these legacy automakers catching up to Tesla, and Tesla is in some ways worried about that. However, they have large margins, they're able to cut the price, and they're hoping to squeeze these legacy automakers, but it speaks to that competition that's in a market that has not fully matured yet. So you have competition over market share, but you also have competition over basic resources like batteries and chips, both of which are very much in use in EVs. And this is something that, you know, is a major focus, not just for the automakers, but for Olaf Scholz this week, who was in Chile and Argentina, trying to secure key parts of the supply chain, lithium, in order to be able to, you know, bring this economy into the electric future.
All right, Oliver, thanks very much. Bloomberg's Oliver Crook there, reporting from the Ford factory in Cologne, Germany. Thanks very much for joining us. Now, coming up, Jeremy Stretch, CIBC head of G10 FX strategy, joins us to talk about what to expect from central banks and the economies this week. And on emerging markets, we're going to speak with Vivian Lynn Thurston, portfolio manager at William Blair Investment Management. Plus, the Black Swan author, Nassim Taleb, says the path back to normal interest rates may be challenging. More from that exclusive interview ahead.
The net effect that we're going to have normal markets. The road to get there will be very painful for some. And not us, of course, but the situation today, and Mark has pointed it out, we have more debt than we ever did in history. We have the weirdest valuations in history. It's not going to be as smooth as it was for the last 15 years.
What do you like most about your job?
I think the people. I mean, ultimately, we're a people business. A lot of what my job is as CEO of the company is to give those people sort of motivation, to tell them where we're going, to encourage them to come up and do their best work, to encourage them to collaborate. Sometimes you sort of think you're almost a psychologist, you know, as you are a business leader, I think, sometimes.
And so what's your best piece of advice?
I love pitches. I love being sort of leading from the front, if you like, and spending times with teams. I love to see the work that we're doing. When we pitch for a piece of new business, often when we come together. So I guess I try and put myself in the seat of the client. And what's the client going to think when they see this work? Are they going to be excited? Is it going to turn their brand around? How's it going to resonate with their consumers? So as much as possible, I think probably I try and play that role.
The Fed is expected to dial back to a 25 basis point hike.
They want to make sure they don't go too far.
A pivotal moment to make some decisions.
But will they go so far as to signal a pause?
We have a long ways to go.
Trust Bloomberg for the fastest coverage and exclusive analysis, including former Fed Vice Chair Richard Clarida.
Recession fears are tangible.
What's the mistake this year? Doing too little or doing too much?
Stay tuned. This is going to be with us for a while.
Bloomberg Surveillance. The Fed decides. Wednesday on Bloomberg, your global business authority.
Welcome back to Bloomberg Surveillance. This is the early edition. We are simulcast on both Bloomberg Radio and Bloomberg Television. For those of you listening on radio, I'm going to walk you through a very cool Bloomberg function I've pulled up. It's an old favorite of mine, highlighting the relative rotation of sectors in the S&P 500 index. It's RRG Go on the terminal if you want to use it for any index. In any case, what we've seen is very interesting, I think. Healthcare, consumer staples, and utilities are in the lagging quadrant here. Meanwhile, the big gainers are tech stocks, consumer discretionary, and telecoms. That seems pretty bullish to me, unless, of course, this is just a short covering reversal of some tax sales that we had at the end of last year. Let's bring in Justina Lee, Bloomberg Markets reporter, to talk about, what this rotation means. Justina, is it bullish? Should I be excited by this if I'm long?
Yeah, there really has been an incredible risk on rotation this month. I mean, some people might even call it, a dash for trash, because you've had even the most shorted stocks going up and the risky, speculative, profitless tech stocks bouncing back. And I think what that really shows is that it's not just that markets are expecting a slower pace of rate hikes from the Fed, but they're also expecting a soft landing at the same time. Now, the question here is whether this is overly optimistic, given all the economic data we've been looking at.
Well, to that point, Justina, I find it hard to reconcile expectations that the economy is going to be better than expected with expectations that the Federal Reserve is going to have to turn around very quickly and start cutting rates. How do those two things make sense together?
Yeah, and I think some of this might even be self-defeating, because as the stock market rallies, we have seen financial conditions, loosen as well, which is exactly the opposite of what the Fed wants to see. So we also have to see what they say about this phenomenon into this month's meeting. And I think it's really been what the stock market has been telling us has really been counter to a lot of other indicators, such as the yield curve going inverted and the economic surprise index turning negative, and even some earnings estimates are starting to slow.
What do you think about the idea that with the reopening of China, Justina, and things not really as bleak as we may have expected in Europe, we're going to see a big lift to commodities? Because it hasn't really been borne out yet. I noticed WTI was still trading at $76 a barrel today.
Yeah, it hasn't really happened this month, and I think China's reopening is definitely a good signal in that direction, but that's going to take some time to feed through into demand for commodities, because what we saw in the first wave of China's reopening is a lot of people were still pretty scared to go out and spend, and I think China is still struggling to go out of that phase, but a lot of economists are expecting that we should start to see that in the quarters to come.
And finally, Justina, given it is still earnings season, has there been a clear takeaway from the reports we've gotten thus far as we wait for many more today and over the course of the remaining weeks?
Right. I mean, from a top-down perspective, estimates are coming down, so earnings growth is expected to slow. But one thing that's been kind of interesting that a lot of sell-side strategists have noted is that investors have reacted more to earnings beats, meaning they're rewarding a lot of those companies that have managed to exceed expectations, but they're punishing the misses a bit less. And so that's a bit of a mystery here, but I think that might also speak to the optimism that's in markets right now.
All right, Justina, thanks so much for joining us. Bloomberg's Justina Lee talking us through the changes in sentiment that we have seen and explaining some of the drivers that we could be looking at. For more market analysis, check out MLIV Go, the MLive blog on your terminal. This is Bloomberg.
No one covers the world like Bloomberg.
The return to pragmatism is really that everybody's in line. The government, the enterprises, the people, in pushing this economy. It's like a cycle of renewal.
Big tech layoffs rolling in. Spotify, the latest to tighten its belt, with plans to cut 6% of its employees.
Is the economy unfolding as you thought it would?
I think the economy is responding to work that the Federal Reserve is doing.
Bloomberg, your global business authority.
So what's the best investment advice you've ever been given by anybody?
The compound interest, the compounding of returns is an incredible miracle of business, finance, and human existence. Everything you learn is additive every day, and if you keep at it and don't quit, it's an incredible miracle. And it's not just interest. It was always said about compound interest returns, compound business returns, compound human returns. They're all very additive because you learn every day. And if you keep at it, it's very, very helpful.
In your observation of investors, what do you think is the biggest mistake that average investors make?
Selling at the wrong time.
And they sell when the prices go down?
Yes.
Or
yes. Not keeping, look, people have conviction, or they invest for if they invest for the right reasons, just keep at it.
In a multi-trillion-dollar industry, there's a lot of ground to cover.
Commodities got absolutely crushed.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg. As growth forecasts are increasing and inflation is falling, will the European Central Bank make its fifth rate hike in a row? How high do rates need to go? Bloomberg Television and Radio brings you the breaking news from Frankfurt and detailed analysis after ECB President Christine Lagarde's press conference.
The central banks, and certainly the ECB is pushing this line, have got much more wood to chop. They've got much further to go.
Coverage begins Thursday, only on Bloomberg, your global business authority.
This is Bloomberg Surveillance Early Edition. I'm Kaylee Lyons with Matt Miller in New York. Anna Edwards is off today. Now, keeping you up to date with news from around the world, here's the first word. In China, manufacturing and services expanded for the first time in 4 months. The country's reopening from COVID-0 continued, and the Lunar New Year holiday spurred travel and spending. It's welcome news for the global economy, which is cooling and will rely on China's recovery to offset other risks. Samsung Electronics is defying the downturn in the chip industry with aggressive capital spending. The company is keeping it at last year's level. Rivals have pulled back to alleviate pressure on the battered semiconductor industry. Samsung warned that it expected a recovery in chips to begin only in the second half of the year. The Biden administration is stepping up its crackdown on the Chinese industrial sector. Authorities are considering whether to cut off Huawei technologies from all of its American suppliers, including Intel and Qualcomm. Huawei is long suspected of ties to Beijing's government and the Chinese military. And in Norway, the $1.3 trillion sovereign wealth fund reported its biggest loss since the 2008 financial crisis. The fund lost more than 14% last year. It was hit by rising inflation, credit costs, and the fallout from the war in Ukraine. And we have an interview, Matt, coming up later on this morning with the Norway Wealth Fund CEO. I know that's one you are very much looking forward to listening to.
Yeah, Nikolai Tangen, I have been following his career with curiosity since he became the leader of this wealth fund. He had to give up a lot in order to take this position, and it's not, the lucrative, high-paid job that you would expect that it would be probably in other parts of the world. But in all fairness, he did say it was going to be a very tough job, and he delivered.
Indeed. Well, speaking of tough jobs, central banks this week have a tough job to do as they make their rate decisions. The Fed, the ECB, and the BOE all on deck. We'll discuss it all with Jeremy Stretch of CIBC coming up next. This is Bloomberg.
most fascinating entrepreneurs, because you also started really young. What did you learn? Did you always think that you'd be an entrepreneur?
Probably, yes. I think, which is a bit sad,
From
isn't it?
age, what, 5,
Well,
6?
maybe, I'm not sure. I come from a family of entrepreneurs, so even though I probably can spell the word and still can't occasionally, it's sort of in my blood. But it's really fun starting a business. And fun growing a business. I feel it's a real privilege. And I started my business officially at 18, but I think I knew I wanted to do it very differently from about 15. But I'm sure it's, if you're surrounded by it, it feels very natural. So yes, it's fun.
And it started how? You started by you went to Florence. It was in Italy, and you started handbags.
Yeah, so I knew I was actually given a handbag by my mother when I was about 16, one of her old handbags, and I remember how it made me feel, and I think fashion is fascinating for the mood-changing, the confidence-boosting aspects, the sort of tribal aspects of what fashion does. And so I went at 18 to Florence, knowing that was the home of leather goods, which is what interested me. I just wanted to learn, actually, and be surrounded by craftsmen who, making things is important, and that's going to be very interesting, I think, over the next sort of 10 years. I think the onshoring of craft and manufacturing is going to be fascinating, actually. I watched the offshoring. I literally saw it, and I think we're going to be seeing that coming back to local. We have to. When we're all looking at our objectives in terms of carbon, proximity is going to be key.
Markets countdown in Europe. From the financial centers of the world, Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays.
This is Bloomberg Daybreak with Lee.
On Bloomberg Radio.
Welcome to Daybreak Australia.
This is Countdown to the Close. Welcome to Bloomberg Crypto.
This is Bloomberg Surveillance Early Edition, and here's what you need to know. UBS does better than expected in the fourth quarter and will buy back more than $5 billion worth of shares. Rising interest rates helped offset a slump in trading fees and transaction income. The IMF sees a turning point in the global economy. For the first time in a year, the fund is raising its growth outlook, and the sell-off of Adani Group has wiped off $75 billion in market value, but the flagship's $2.5 billion equity sale is now fully subscribed on its final day. I'm Matt Miller with Kaylee Lyons here in New York. Anna Edwards is off today, so I will run you through a check of the markets, kicking it off with Europe, as Anna typically does. We're down on the stock 600 right now, about 0.7%, the drop that we're looking at in the cash trade, and investors are buying debt. So pushing the German 10-year yield down just about 2 basis points to 2.301. Meanwhile, UBS shares are actually falling. Even after it said it's going to buy back $5 billion of shares, it looks like investors are concerned about the slump in trading revenue and transactional fees. We're going to talk to Manus Cranny about that in just a moment after he interviewed the CEO. The rest of the banks in Europe are doing really well. I think represented perfectly by UniCredit, which is up more than 8%. Interest rates are really helping banks, and others like SEB and Swedbank are also faring well, rising in terms of their share price in trading today. Now, in terms of the U.S., it is, as Kaylee reminds me, the last trading day of January of the month, and we're down on futures about 1/3% after coming down 1.3% in the cash trade yesterday. So it has been a pretty good month. We're up 4.6% even with these losses, but it looks like investors are taking some profits off the table. They are also buying debt here, and that pushes the 10-year yield down to 3.5309, going out 5 significant digits. They are bidding up the dollar in what has become really a risk-off sign. So the Bloomberg U.S. dollar index up now to 1228.25 today, and this is the third day in a row of gains for the greenback, so that's not terribly positive for equities. Also, not a great sign in terms of what investors think of the economy is NYMEX crude coming down again today, $76.72 a barrel. Brent is falling as well. So, Kaylee, it looks like there's some concern about economic growth, even with the IMF raising its forecast.
Yeah, that definitely still seems to be lingering out there. And you're seeing concern about perhaps the idea that we saw some stocks running too far, too fast, now trickling into losses, potentially for a second day for some of these companies, like Lucid Group, which of course is an EV maker. It fell more than 6% yesterday after research group Fuzzy Panda said it is short this stock because it thinks the buyout rumors from Saudi Arabia's public investment fund are not true. So that stock is down another 4%. Remember, Lucid had rallied 65% last week on those reports. Fuzzy Panda, yes, I had to Google it. It is a research firm. Also, a lot of Google images of stuffed panda toys came up in that Google search. Elsewhere in the EV world, Tesla is down for a second day, too. It's down the better part of 2% in pre-market trading this morning. So unwinding some of that really remarkable gain we saw for the stock last week, which was the best for the stock going back to 2013. I want to note some chip makers as well. NVIDIA saw its 6-day winning streak snap yesterday. All that AI-fueled boom in the stock seems to be coming to an end. It's down another 1.6%. And then another chip maker, the second largest maker of PC processors, AMD, is going to be reporting later today, down 1.6%. Ahead of those results. Remember, if Intel is any clue, Matt, the PC market is really, really weak, so we'll see how that fares when we get that report from AMD later on today.
All right, looking forward to that. Let's talk now about the economy and central banks. Joining us to do that, Jeremy Stretch, head of G10 FX strategy at CIBC. Jeremy, obviously, it's a huge week for central banks, and this is what has really been driving the markets across asset classes. What do you expect from the Fed tomorrow? Are we going to get a really hawkish 25 basis points?
Yes, I think that's what Chair Powell is going to try and push through the market. Clearly, he's going to try and walk the tightrope of saying that the Fed are getting nearer the inflection point in terms of policy adjustment, but we're not there yet. But more importantly, he would try and push back against that market pricing for rate cuts in the second half of this year. So I think it is going to be this hawkish narrative that he's going to perpetuate from December, and I think markets will remain relatively nervous going into the event. It may well be the case that the dollar has a little bit further to travel in terms of gains, but I think it's still a case that we can actually look to fade those rallies because ultimately we're getting close to that end game as far as the Fed tightening cycle is concerned.
In terms of the ECB, do you expect them to be more hawkish? Because we've really seen a turnaround in the currency, and it looks like investors are betting that the Fed can pause while the ECB will continue to hike at 50 basis point meetings.
Well, if you go back to December, the ECB narrative was very much the steady and significant mantra, and that implies 50 basis point clips in terms of monetary tightening. But when you look at the underlying macro story in the Eurozone, it has materially improved from where we were back in the autumn, when we were very concerned about both gas prices, but also the risks of gas rationing. So those IMF upgrades that we've seen released overnight did actually produce a small upward momentum or degree of expansion in terms of the German economy, and I think that gives the ECB a little more latitude. So I suspect this week's meeting will be very much a 50 basis point clip, leaving the market assuming and anticipating another 50 basis points in March. But I think that March meeting will be much more important because, of course, that comes with the updated and uprated staff forecasts. And I think that will be much more significant in terms of the policy dynamics. But for now, the ECB is deemed to be much more hawkish than the Fed.
And yet it's interesting because you have perhaps equally remaining strong data on both sides that you could point to, Jeremy, the idea being that why would the Fed slow things down or feel the need to pivot anytime soon when the ECB doesn't?
Well, I think in a sense you also need to reference what a pivot means because, of course, the Fed is slowing the pace of tightening at this meeting. It isn't necessarily sanctioning or warranting a discussion about a rate cut, which in a sense is a full definition of a pivot. But I think the Fed have been tightening policy very aggressively, and there are now significant signs that some of those inflationary influences are starting to moderate, not fully, but moderate, and the labor market is an issue. But I think in the Eurozone dynamic, there is still significant degrees of inflation stickiness, particularly in terms of core prices. And I think in the course of the next 24 hours or so, the markets will be monitoring both the release of the German flash inflation data later today and the Eurozone metric tomorrow after that upside surprise in Spain yesterday, which did cause the market a degree of consternation as to whether the inflation profile is going to be a little bit stickier in the Eurozone than compared to the US.
And there's one more area or central bank we need to talk about this week. That would be the Bank of England. You are against consensus seeing a 25 basis point hike this week. Why?
Yes, that's right. I think if you look at pretty much all of the real economy data, and we've just seen this reflected in terms of the mortgage approvals and consumer credit numbers this morning, pretty much all of the real economy data has deteriorated and deteriorated very sharply. Yes, average earnings are still running at very elevated levels, but I think there are starting to be some signs that the labour market is also starting to moderate. And I think the Bank of England's inflation profile still suggests that the inflation dynamics are still set for a substantial correction over the course of the 2-year time horizon. The UK's inflation profile is slower to fall, yes, compared to its counterparts, but I think the real economy data is going to be very challenging in terms of demand-driven inflation. So I think that gives the opportunity and the latitude for the Bank of England to slow the pace of policy tightening. But I think we will get a very elevated degree of split across the MPC once again this week. And I wouldn't be surprised if we once again see a three-way split in terms of the voting patterns. But we're looking for 25 basis points and accordingly looking for sterling to suffer and the rate profile to be impacted accordingly.
Jeremy, what are the most interesting pairs that you're following right now? What gets you excited when you wake up in the morning and head off to CIBC?
Well, I think, certainly from the sterling dynamic in the context of that out-of-consensus call in terms of the Bank of England, I think is a currency that we continue to monitor. We like in the short term just fading the euro rallies a ball north of 109 because I think there are better levels to come back to euro. And if we are going to see a more constructive euro backdrop across the year ahead, then I think you can perhaps look at some of the leverage plays off the eurozone, and then that takes you back to somewhere like Sweden. So I think there are plenty of opportunities outside of the dollar perspective and dollar sphere in terms of interesting currency pairs moving forward.
All right, excellent. Thanks so much for your insight this morning. Thanks for joining us. Jeremy Stretch, their head of G10 FX, talking to us from our London offices. He's from CIBC. Coming up, Vivian Lynn Thurston, portfolio manager at William Blair Investment Management, is going to join us. This is Bloomberg.
For the first, call it 18 years at Chipotle, this was you come into Chipotle along the line, you interact with the crew, and you customize your meal. We've got this separate make line, and it's digitized, and so the orders come in, and they're really kind of staged so that if you say at noon, I want to come in at 1 o'clock, we hold that order, and we will send it to the crew like maybe 10 to 1,
right.
So it's ready right when you pull up your car.
How do you manage these kind of two different staffing needs, right?
Yes.
And making sure you have the right amount of people
Yes.
at the right time.
We spend a lot of time projecting sales. A lot of it is, it's part art, part science. We're trying to bring more science and more AI into it. Because if you get the right sales projection, then you know exactly what your staffing needs to be. So if you get the sales right, you can get the entire restaurant staffed perfectly. With just a couple people, our average restaurant now does about over $1 million per restaurant in digital sales.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
This is Bloomberg Surveillance Early Edition. I'm Kaylee Lyons with Matt Miller in New York. Anna Edwards is off today. Well, China's reopening is set to provide a welcome boost to global growth, offsetting weakness in Europe and a looming possible recession in the U.S. But there is a catch. A boost to inflation at exactly the moment the Federal Reserve and other central banks race to bring it under control. That's the topic of today's Big Take. And to join us to discuss it further now is Vivian Lynn Thurston, Portfolio Manager at William Blair Investment Management. Vivian, thank you so much for joining us. When you think about China, and we got better data out of China today in the form of manufacturing and services PMIs, how do you weigh the growth impulse against the possible inflationary one?
Yeah, thank you, Kaylee. That's a very good question. And first of all, we do believe that the reopening will lead to the recovery of China consumption and normal economic activities in 2023. But in terms of the impact on inflation, I think it could be more moderate than we expected, or as we have seen in the Western world or other part of the world when the reopening happened. So if we look at the China current CPI, it's pretty moderate, about a little bit over 2%. And that has been the case throughout the early reopening time in 2020. Part of the reason that China structurally has a little bit lower inflation, given that digital economy is a very big part of the economy, therefore always function as a price deflation factor. And secondly, Chinese manufacturers tend to absorb quite a bit of the price increases on the raw material side. Therefore, we have seen the PPI probably pretty high or elevated for some period of time, but CPI has been moderate. So the debate will continue to go on about the reopening of China. How does that impact the global inflation? But my thinking is that it could be more moderate.
Vivian, can you look at what happened in Europe? Can you look at what happened here in the U.S. and, take lessons from our trajectory and apply them to what you may expect in China?
Yeah, I do think from incremental perspective, China will see some increase of inflation, given that it's still very moderate at this point. But I do not see that this will be the same magnitude as we have seen in the U.S. So from the wage inflation perspective, U.S. that was a very big driver at the beginning of the inflation surge. In China, we will probably see some wage inflation from a lower tier kind of employment. But overall, the employment level has been quite healthy. The unhealthy part was more the younger generation youth employment. So unemployment rate was about 20% at one point for this generation. And that definitely will impact the service side of the inflation. But overall, I think the structure of the employment or unemployment rate in China will also make the inflation more moderate than we have seen in the U.S.
Let's talk about how all of these economic factors factor into actual equity prices, because we have seen a remarkable rally for so many of these stocks. I mean, the Hang Seng Tech Index is up 70% from its lows in October. So I guess the question is, Vivian, how much of the reopening news is already baked in?
Yes. First of all, this is from very, very low trough. I think that's bottomed probably the end of October. So if you look at in the last 2 years period, even with the recent rally, Hang Seng and MSCI China is still at a pretty low level. So I would say the first leg of the kind of improvement due to the sentiment repairment is taking place. But going forward, I think the driver will come from the earnings recovery. And I think that won't come until probably from the second quarter of 2023. So I do think there's still more to come for the overall equity market, even though I think in the short term we may see some consolidation given the very strong run-up in recent times.
Vivian, for many months now, we've been talking to portfolio managers who are fascinated with India. They think it's the next big thing. It's got a growing population, about to eclipse China, a much younger demographic, and it seems that all of that has now soured with the Hindenburg research release on Adani. What's your take on that saga and how it shifts flows from China to India and now possibly back again?
Yeah. India remains a structural growth story from our perspective. You just mentioned a few key drivers, where the rising middle-class consumption and also the country continue to pursue for this Made in India kind of strategic focus. So those structural factors actually have not changed, and this will continue to be a very good support for Indian equities going forward. But if you look at Indian equity, one key risk is that valuation was very high. Indian equities always trade a premium to the MSCI emerging markets equities. And I think towards the second half of last year, that premium even enlarged. So it's not surprising that we see a little softness of the Indian equities in recent times.
But you're not. So Vivian, you're not put off by the Hindenburg report on Adani. You don't see it as an attack on India at large.
I think that's more company-specific, idiosyncratic kind of development, even though I think the spillover effect needs to be watched closely, whether this will impact some of the banks, which have some kind of the lending activities with the company. But overall, we don't see this as a big kind of a contagion effect for all companies or the economy of India to that extent.
Excellent to get your thoughts, Vivian. Thank you so much for joining us. Vivian Lynn Thurston there of William Blair Investment Management. Coming up, the author of The Black Swan has a warning about the road back to normal. Part of our exclusive interview with Nassim Taleb next. This is Bloomberg.
And shallow recession, plain vanilla, garden variety is totally delusional. I mean, it's totally delusional because we're not going to have only inflation. We're not going to have only stagflation. We'll have a stagflationary debt crisis, the worst of the 70s and the worst of the post-GFC period. That's what's going to happen.
I got to say, you're not helping with my anxiety levels right now.
I'm going to go. I'm moving my portfolio to cash. 1 second. I got to pause it. Pause the.
Well,
podcast.
Cash is not enough because it's wiped out by inflation. You have to go to assets, and I can discuss. They can hedge against inflation.
Stagflation already seems like the nightmare scenario for central banks if you have high prices and lower growth. But if you tack onto that a debt crisis plus stagflation, that just seems like incredibly difficult for any central bank to navigate.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
This is Bloomberg Surveillance Early Edition. I'm Caitlin Lyons with Matt Miller in New York. Anna Edwards is off today. Now let's take a look at what Anna is missing coming up in the day ahead. At 8:30 a.m. Eastern Time, we'll get an insight into wages and salaries in the U.S. with an update on the Employment Cost Index. Then there's some more data at 10 a.m. with the latest consumer confidence numbers. And finally, it is a big earnings day. Exxon, Pfizer, McDonald's, and Caterpillar are all among companies scheduled to report earnings before the opening bell, Matt.
All right, I'm sure Anna has other things to focus on, or at least I hope that she does, instead of the Employment Cost Index. But we will be watching it very closely. Also, the Black Swan author, Nassim Taleb, says the stock market is way too overvalued for the current interest rate. Taleb spoke exclusively to Bloomberg's Sonali Basak in Miami.
our strategy at Universa does not depend on what we think of the stock market. So it doesn't change whether Brandon believes that it's going to be rosy forever and Mark, or whatever. It doesn't, or if you think that so the strategy here is not about timing markets or environment. There's a structured policy of having geometric payoffs and the tails. But to go back to the environment, I believe that the stock market is way too overvalued for interest rates that are not 1%. So unless they miraculously bring back interest rate to 1%, which they won't be able to, we will have interest. I mean, it's unsustainable. Why should you put your money in a stock that gives you 2% dividend yield, if you're lucky, when you can get 4.75% from the bank while playing golf? Explain to me the logic, right? So this is why the stock market has to adjust to normal levels. And again, we haven't had that much growth over the past 25 years to justify this valuation. So it's just there.
Sonali joins us now from Miami, extremely early in the morning, especially for that part of the world. Sonali, I think this is fascinating, especially considering your reporting on Mark Spitznagel yesterday. The two of them have worked together in the past, and they're both worried to some extent about, to an enormous extent, about the global debt situation.
It was interesting because Mark Spitznagel wasn't there, and Nassim Taleb actually, to my knowledge, had not read his letter. But they had two different ways of describing a similar situation. Mark Spitznagel, in a letter to investors that I had obtained, had described it as a tinderbox time bomb akin to the 1920s, where the global debt load, particularly in corporate debt, fueled by central banks, has ballooned to the point that it sets up conditions similar to the 1930s Great Depression era. But then you have Nassim Taleb, who described it differently and explained it as something like a tumor. He explained it as something that is kind of deep and burning inside the markets that will have longer term ramifications. And he described that for things like crypto. He described it in terms of the stock market and how many companies there are without cash flow. And he described it in terms of real estate. So there were definitely certain areas, you and I might call it a bubble. He calls it a tumor. Mark Spitznagel calls it a tinderbox time bomb.
I prefer a tinderbox time bomb, frankly, to a tumor.
Wow, right, but language.
When does this time bomb go off? Did either one of them give you any indication, or what's going to set it off?
That's the great debate. This is the black swan author we're talking about when we're talking about Nassim Taleb. And one thing I asked him was, you think about 2020 when you had a return on their invested capital in a month of 3,600 or more based on the insurance return that you were getting on their strategy. But you look at over time and the return on compounded annual growth rate, so that's a completely different measure, is about 10.4%. In 2022, they didn't provide their returns. And 2022, over the full year, you had one of the worst years you've had in more than a decade in the S&P 500. When I asked him what was the difference, he said the difference was the shock of a return you got in 2020 versus the controlled burn, as Mark Spitznagel said it was in 2022. So the payoff is different, and it's spurred this huge debate on what is a hedge fund, what is it supposed to do for you, and what kind of return are you looking for at the end of the day? Because CTAs, trend followers, huge kind of competitor in the market to a firm like Universa, made a lot of money last year. But Spitznagel argued that had not made you a lot of money over the past decade.
All right, Sonali, we have to leave it there, but thank you so much for waking up early for us. Have a good day down there in Miami. Bloomberg Sonali Basak, we appreciate it. And Sonali mentioned she was talking about crypto with Nassim Taleb. We'll tune in for more crypto talk today on Bloomberg Crypto. That's at 1 p.m. New York time, 6 p.m. in London. Our weekly show with Matt and I covers the people, transactions, and technology shaping the world of decentralized finance. That wraps it up for Early Edition. More surveillance is ahead, including conversation with Nikolai Tangen, Norges Bank Investment Management CEO, among others. This is Bloomberg.
So the inflation environment has been changing a little bit. Inflation's been very low for 25 years. Now people think inflation's coming back. How are you going to deal with that?
I think many of the tools that we've historically used to battle inflation no longer work in the same ways they used to. I think people oftentimes thought of housing as a way, or especially retail and real estate as a way to hedge against inflation. Less and less possible the way we've invested in it. I think commodities similarly have been thought of as a way to hedge against inflation. There are challenges over the long term. Equities have been a hedge against inflation. We will continue to do what we have done in the past, which is build a diversified portfolio where there are many different opportunities that have the possibility of hedging against inflation, because different types of inflation have to be hedged in different ways. So if it's a very quick increase of inflation as opposed to a slow rise of inflation, is it temporary? Is it a long or persistent type of inflation? So for us, I never model myself an economist that can predict where inflation is going. And so what I need to do is build a diversified portfolio where there are different options that can fight the different types of inflation, and to pay close attention to it. And you know, fundamentally, it's done through the equity markets.
From the world of politics to the world of business, Balance of Power with David Weston brings you news, analysis, and insight from and about politics power players. Balance of Power, weekdays on Bloomberg.
This is Bloomberg.
There are opportunities for this rally to go longer and higher than you would expect.
It's not a strong growth picture. It's a grind, but I think it stays positive.
We're not as comfortable as I think the market is, that the Fed is done here, that they will get inflation under control, that we will have a recession.
If we are going to see a recession sometime this year, I don't think that's priced into the S&P at all.
If the data continues to moderate and inflation continues to fall, that's your hike and pause in March scenario.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
I heard in Variety magazine that you didn't like me and you were staying away for an extra day.
I was. I stayed away for an extra day. My people talk to you. I'm going to tear up here, folks.
You've got to stop leaking.
It's the first time we've been together since the market didn't go down.
You've got to stop leaking. Your people just, you know, telling Variety magazine. Equity futures this morning. Good morning, good morning. We are negative by 0.5% on the S&P 500. For our audience worldwide, this is Bloomberg Surveillance on TV and radio. TK, welcome back. Good to catch up. Massive week ahead. Bravo and I did that yesterday. You want to pick up on that story now?
Yeah, I'll pick up on it today and just say Monday, wait, Tuesday, wait, and then tomorrow the festivities start. And it is a very, very important week. And I think Jobs Day, with its wage dynamics, is maybe Chairman Powell wishes he was having this meeting next Monday rather than Wednesday.
I'm with you, Tom. I'm with you. He'd like the data. You've got Steve Englander over at Standard Chartered, TK, saying that maybe we could have a pause at the March meeting. Is this the final hike of this cycle?
It's under debate. It's under just, you know, Anna Wong's out with Bloomberg with her historic call on a way above 5%. She absolutely nailed that. And, you know, I don't know what the dynamic is. And what's important, John, I look at the Bloomberg today, the screen, the market doesn't know what the dynamic is. And, you know, the press conference tomorrow is not going to be a small item.
Well, this market has been ahead of the projections of the IMF, that's for sure. The IMF calling this one, Lisa, a turning point for the global economy. And you have to say that's backed up by the data out of China a little bit earlier this morning.
It's backed up by the data out of China. It's backed up by the data out of the European Union, where you can see growth coming in better than expected. It's not backed up by earnings, at least not in the U.S., and that's what I find interesting. There is a divergent story that underpins the currency move that you've seen, both with China and Euro doing really well.
You're missing the punchline. The United Kingdom flat on their back. I mean, even France.
I think she was just being kind, Tom. I'm not sure she missed it.
France went to a positive statistic. But, John, I mean, this really, and just in the zeitgeist of the last 24 hours, the idea of the Brexit effect, away from COVID, away from the politics. I mean, you know, they had a footnote. Ganesha had a footnote at the IMF that the GDP slowdown was due to Tottenham. I get that. You know, there's no question.
That was the punchline, by the way.
But,
that's the actual
it's
punchline.
Brexit.
Come on, it's a Brexit effect.
I think it's more than that, Tom. It's the fact that we've had to have tighter fiscal policy, tighter monetary policy. Negative 0.6% is the projection from the IMF. That's the IMF's view on things, but it's a real downgrade from the previous view back in October. When you look at the US, it's an upgrade. When you look at China, it's an upgrade for obvious reasons. And the UK seemingly jumping off the screen for everyone is the odd one out.
What did you observe in the United Kingdom? Did you observe?
Yeah, I didn't feel recession in London.
Exactly.
To be very clear, in London's still booming.
But when I was in Paris X months ago, I'm like, this is a slowdown, and they came in today.
A lot of people feel that way.
Data.
The BOE is still set to hike on a Thursday. The ECB is set to do the same thing. I don't think Europe's out of the woods either, before we get excited about that. Bramo, you look at the inflation figures from country to country over the last 24 hours. The ECB's still got work to do.
Which is the reason why the main question now is what kind of reopening have we priced in? What kind of non-recession have we priced into Europe? And have we already gotten to the point where we've priced in more than we're actually going to see?
Let's whip through the price action for you briefly. Equity futures down 0.5%. To TK's point, the week really begins tomorrow with the Federal Reserve decision, a ton of earnings, then payrolls on Friday. Futures a little bit negative, adding to the losses from yesterday, but year to date we are still absolutely flying on the Nasdaq. On the Nasdaq 100, up by 8.9% over the last 4 weeks and change. Yields unchanged on a 10-year, 353.27, and euro dollar negative just a little bit here, TK, 108.26.
Yeah, two numbers. One, the Bloomberg Financial Conditions Index. I've seen this more in the media, which is good to see. There's other ones as well, but it's gone a little bit from accommodative back to ever so slightly trend towards some form of restriction. And the VIX, wanders back 20.58. We've given up that bull market glow that we saw in your sabbatical in England.
Is that a dig? Is that a dig?
It's not a dig.
Just right at the end.
I don't know. You and I got to go right back Sunday, February 5, Tots, Manchester City at Tottenham.
I was still working.
Oh, you were working.
I was working.
Yeah, there's
Nasdaq
proof
futures,
at Fulham.
a bit softer. Bramo, TK took too much time off, didn't he?
Oh, you're going to do a tit for tat there. I'll do a tit for tat as well and say that today absolutely the week begins. 8:30 a.m. with employment cost index coming out for the fourth quarter of last year. This to me is going to be more interesting, sort of the under the radar kind of data to give a sense of how much wages are increasing and what the Fed can look at in terms of the inflationary pressure there. At 9 a.m. we get a bunch of housing data, including the S&P CoreLogic price data for the month of November. How much are prices coming down, or are we seeing a flattening out? Because if you talk to a lot of analysts, they've all been talking about how we've seen the worst, the biggest part of the slowdown in the housing market. If that's true, that sort of tailwind to keep inflation going lower isn't going to be as strong as some people had expected. Today, the earnings parade continues to roll out. We did just get UPS, which did give a worse than expected projection going forward, and those shares are dropping. After the bell, we get Advanced Micro Devices and Western Digital after getting NXP after the bell yesterday. To me, I am watching the semiconductors. NXP followed along with all of the others, giving a negative projection or a disappointing projection for the year ahead. Advanced Micro Devices and Western Digital will give some projection to give a sense there, but also really following on to what we heard out of Washington, the potential to restrict some exports to Huawei. Does that really affect some of their outlook as well, John?
Lisa, thank you. TK, what have you got?
UPS, I'm sorry, I'm going to go to this. This is use of cash through earnings season. Of course, we'll talk about this with this huge earning release, John, that we see. I believe it's in 2 days. UPS, share repurchase, capital spending on target, and a 6.6% dividend increase. They're falling apart.
The Snapchat later as well. Have you seen that stock year to date? The stock is up by almost 24%.
I look at car sales, and tools, I look at Snap-on to do okay.
As for GM, which we get a little bit later, I believe we're catching up with the CFO. I'm going to let that go. You can't stop laughing. As for GM, Lisa, I think it's going to be very interesting if we get price cuts, more price cuts. That EV price war in the United States, for a lot of people, just starting to build.
So yesterday, Ford coming out and following what Tesla had done, cutting some of their electric vehicle pricing. Is this a price war that's going to go beyond the auto sector? Is this just an EV sector? How much does this really cut into margins?
I know we got to get the yens. Ford, they're going to refund part of what the people who just bought the car overpaid
Oh, really?
for.
I missed that, Tom.
Yeah,
that's
it was
very
buried
cool.
in a paragraph. But to me, that's the headline.
That's very cool.
Basically saying to Elon Musk and you.
Tesla,
Can I say that on radio and TV? I don't know.
I think you just did. Jens Nordvik joins us now, founder and CEO of Exante Data. Jens, Steve Englander this morning from Stand Sharp. We think the incoming data will be soft enough for the Fed to pause in March. Do you agree?
I think the Fed doesn't want to signal anything in that direction right yet. They are in the process of slowing the pace of tightening, right? It's well telegraphed. They want to go 25. I think they view it as the first step here to signal in an orderly way that they're slowing. But I think they're going to be very careful about signaling that they're ready to pause and cut before they know it's the right time.
Yes, to your magisterial work on Europe over the decade, how constrained is Christine Lagarde? How limited are her degrees of freedom in moving forward?
I think we can see it from the inflation data we've had so far in January, right, that core inflation is dramatically above target, right? And the ECB has its roots in the Bundesbank, right? It's an inflation targeting central bank with no dual mandate. So they don't have much wiggle room. They need to go aggressive. And they've signaled, obviously, that they are on a pace of 50. Even if the Fed is slowing to 25, they're going to continue to go at 50. And that could be for the next 2-3 meetings. And that will finally start to take the rate in Europe into restrictive territory.
So when you talk about the euro at this moment, how much do you price in the downturn that you could potentially see as a result of a tighter ECB policy, as well as some of the more negative pressures coming in, really revealing themselves more directly?
Yes, it's been a very interesting situation around growth in Europe, right? Because we've had incredible pessimism about the energy shock and also the effects of tightening, right? But the reality is that we've had barely any negative GDP readings. And now the energy prices have actually reset low, right? Natural gas prices, including in futures, are essentially back to before the Ukraine invasion. So there's a number of the tail risk factors that people were incredibly concerned about that have actually receded. So we obviously have monetary tightening in the pipeline, but some of the other growth drags are actually abating. We also have the China reopening that's going to be positive for global growth and some European exports, right? So it's a pretty mixed picture. The inflation picture is very clear, but the growth picture is not as negative as it was 4 or 5 months ago.
Jens, what does the positioning story look like coming into 23, and how's that changed over the last month alone?
Well, there's an incredible amount of focus on China reopening, and rightly so, right? But we can see in the last couple of sessions that some of these China reopening trades that are sort of looking a bit wobbly, even if the underlying data looks better. And then I think one thing is amazing is that the emerging market picture, actually, regardless of what the S&P does on a day-to-day basis, up or down, is trading quite resiliently. I think that's the evidence that this emerging market bull trade that is starting to kick in motion is potentially something that has legs. That's something that's not really been going for a multi-year period. If that starts to get going, that could be something that could go on for a sustained period of time. So I think positioning is like that.
Jens, can you tell me about why that could be a more durable story? Let's take a stock like Alibaba. Let's just throw that out. That's up by 76% from the lows of October. There's many people out there that say reopening story in China, it's happened over the last 3 months. Jens, what do you see that could make this a little bit more durable, away from the Alibabas of this world and to EM?
Yeah, so when we scan around the world, like we tend to look at China and then China X, like the other emerging markets like ex-China, right? And there we can see places like Mexico trades very resiliently, Brazil trades on its own, Eastern Europe trades on its own, right? So it's not all about China. There's clearly some China-linked trades like Korea, China itself, Taiwan, but emerging markets is a pretty diverse spectrum, and we've had more than a decade of bearish sentiment on EM, and we can finally see in the flows that investors are getting back into the EM trades, fixed income and equity globally, really for the first time in multiple years. And when we look at essentially the levels of exposure, they're still very low, right? So we can have positive momentum going on for a long time before the levels of exposure are concerning to us.
Jens, this was great. It's good to catch up. Jens Nordvik there of Exante Data on Europe, on the Fed, on the big global trade. It was Get Long International to start the year, and let's be clear, it delivered. And then, Tom, the NASDAQ rallied by about 9% for the month of January.
In the next 48 hours, I mean, where will we be Friday, let alone on Monday? And I think it'll be driven by the headlines in the news.
The payroll's coming up on Friday, the Federal Reserve coming up tomorrow, and a ton of data and earnings in between. Live from New York, this is Bloomberg.
Keeping you up to date with news from around the world. With the first word, I'm Lisa Mateo. For the first time in a year, the International Monetary Fund has raised its global economic growth outlook. The fund says the world's gross domestic product will probably expand 2.9% this year. That's 0.2 of a percentage point higher than the October forecast. The outlook was boosted because of resilient U.S. demand and the reopening of China. The Eurozone is on track to avoid a recession. The region's economy give them an immense advantage on the battlefield. Ukraine's also asking for advanced missiles. UBS reported fourth quarter profit that beat expectations. The Swiss bank plans to buy back more than $5 billion of shares this year. Rising interest rates help UBS offset a slump in trading fees and transaction income at its wealth management business. And Asia's richest man, Gautam Adani, has completed his flagship company's $2.5 billion share sale. Investors had placed orders for about 100% of the total shares on offer before the end of the trading day in Mumbai. Adani Group stocks have tumbled since being hit with allegations of fraud by Hindenburg Research. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo. This is Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Welcome back to Bloomberg Daybreak Europe.
Good morning, good morning. This is Bloomberg Surveillance.
Welcome to Bloomberg Markets, China Open.
This is Bloomberg Technology.
To our television and radio audiences worldwide, welcome now to Balance of Power. This is Bloomberg. The Fed is expected to dial back to a 25 basis point hike.
They want to make sure they don't go too far.
A pivotal moment to make some decisions.
But will they go so far as to signal a pause?
We have a long ways to go.
Trust Bloomberg for the fastest coverage and exclusive analysis, including former Fed Vice Chair Richard Clarida.
Recession fears are tangible.
What's the mistake this year? Doing too little or doing too much?
Stay tuned. This is going to be with us for a while.
Bloomberg Surveillance. The Fed decides. Wednesday on Bloomberg, your global business authority.
We may have peaked on inflation, but it doesn't mean that the central banks will not further increase some rates, just to be sure. I do think that they are very clear in terms of what they want to achieve. They really want to get the structural inflation down. And that could come along with a real deceleration of economic growth.
Ralph Hammer's there, the UBS CEO, catching up with a good friend of ours, Manus Cranny. We'll catch up with Manus in just a moment. Let's touch base with the price action just briefly in the equity market. Equity futures negative 0.5% on the S&P to close out the month of January with a sizable gain on the S&P of something like 4.5%. On the Nasdaq, up by close to 9 percentage points over just 4 weeks and a little bit of extra trading days. Yields unchanged on a 10-year, 353.83 on a 10-year right now. Euro dollar 108.29. Spanish CPI yesterday came in hot. French CPI still elevated. Maria Tadeo told me German CPI was delayed. Elisa, why is German CPI delayed?
I can't explain that.
I was just shrugging my shoulders and just thought, what? Why?
But if you look at the prices paid index, which is some of the data that has come through for Germany, it's actually come in hotter than people had expected. So this is what we're seeing, the upside surprise on the heels of energy prices that are starting to climb upward once again. Does that start to matter?
Going into the ECB on Thursday, Tom, looking for 50 basis points after a punchy Christine Lagarde back in December. Do we get a repeat of the December meeting over at the ECB?
Mine's a nominal analysis. Do they have the nominal GDP to afford that confidence in monetary policy? Nobody really knows other than there's a war going on, but I do agree with Lisa that if you have a hydrocarbon rebound, that changes all of its mathematics for all.
The China story too. I think the IMF was pretty clear about that. Everyone's jumping on the headlines from the IMF this morning, better projections, all of that good stuff. The China factor, there's so much we don't know, Tom, still about the China factor on both the demand side and, of course, what it means for inflation too.
Yeah, and just to give you an idea how we look at this, folks, I was over my first glass of Tang here a couple hours ago, and I'm looking at 24-month period of 3.1 and 2.9 China guesstimate, which I believe averages out to 24 months of 3% growth. That's not good enough for the leadership in Beijing. They have to do better, and they'll do it by saving the real estate
Is
market.
Europe importing more inflation off the back of that growth?
That's the next worry. I mean, that's, Lisa she's in charge of that.
Of the what, chief worry officer?
Just worry.
Chief worry officer.
I'll just be over here. I don't know what's going to happen.
You just stay there and worry, okay?
Don't worry. I do it every day. Thanks.
Are we ready to go here?
I think we are, yeah. We're just waiting for you.
This is a joy. Manus Cranny is with us, who does Zurich like no one, and he knows that when it is about wealth management on the Bahnhofstrasse, it's about moving from UBS and 45 Bahnhofstrasse down to Hermes at 28A Bahnhofstrasse. I mean, Manus, this is about, there's the train going by. Manus, can you hear me? Oh, they're going the other way, too.
Manus, hi, Tom. I can hear you. Good morning.
Let me cut to the chase. Manus, is this a jump condition for UBS? Can they not be incremental, but can they really jump up given wealth management and the angst of Credit Suisse?
You try to dig into these numbers. There's a pretty big deposit into the Swiss bank at UBS, about $8 billion. It's darn hard to dig into whether there's this flow of money from just down there, Tom. You know Bahnhofstrasse a lot better than I do. I don't get to go into Hermes very much. And you walk up and you arrive here at UBS. So, look, I think that's a moderate distraction. The flow of money in times of angst is something time immemorial. $8 billion is not going to make or break UBS. There are a number of incremental things in the conversation with Hammers. One is the clients are still cautious. They're not convinced. I looked at Tesla, it went from 107 to 170. I said to a buddy before we went away, wow, risk on. He said, no, man. He said it went from 370 down to 105. This is not a risk on market. This is just nervous short covering, and the clients are not yet fully convinced. They're still in cautious mode. Yeah. Cautious clients do not deliver conviction, which is actual transactions in risk assets.
Manus, you're expert at this. What is the UBS distinction? I think we in America, it's a blended blur going back to Payne Weber and all that. From where you sit, what's the UBS distinction versus other European banks?
They have synthesized investment banking to behave as the dog on the leash to feed wealth management. Probably investment bankers up and down at Bahnhofstrasse at UBS will come out and smack me. But what they have done in the past 12 years is they have created a machine that feeds the beast. The investment banking flow feeds the wealth management. Those products that are created within investment banking, they're so much more sophisticated than they were 12 years ago under the Armotti era, and that investment bank feeds into the wealth management. It's a dynamic shift. That's what Credit Suisse have to do. That is why the market cap of this puppy is $72 billion. The market cap of that thing down there, and I need to double check this, I think it's sub $15 billion. They need to reinvent themselves in the way that this bank has done.
Manus Cranny making friends at Credit Suisse this morning. Did you notice that, Tom?
Just it's a charm offensive.
Yeah, they're going to have a great time.
over there.
They're going to have a great time. Hey, Manus, thank you for that, buddy, as always. What happened to the nice shop we used to have by the river? Do you remember that? We used to stand by the river.
What Lisa and I remember when there was the Pharaoh junket.
That was for the S&B. And I tell you, every time I used to go over there, I'd always scratch my head afterwards. You'd have this really, really wealthy country. Everywhere you'd go, there'd be Mercedes blacked out, loads of people got loads of money, all that good stuff. And then you had the central bank freaking out about where the currency was because it wanted inflation high. I just never understood that. That sort of tunnel vision about getting inflation up and the currency weaker when the economy was so wealthy.
And Tyler Burley was just in, I believe, John, you were off on one of your sabbaticals, but, you know, he made Monocle, and he looked at a worldwide search of where to move. I know he looked at Helsinki, and he said Zurich. Tyler said, we're moving the shop to Zurich.
I understand your feeling. Why not just be happy, right? Be happy with the wealth that you have.
Sure, exactly.
You know, just enjoy yourself. Go skiing.
Beautiful country.
It's gorgeous. You guys all have perfect infrastructure. It is beautiful.
It's incredible.
They have so many gondolas
You know what we really
everywhere.
need? What we really needed was negative interest rates. That's what we really needed.
Well, you know, now they're moving away from it.
To tie it into this week, I believe the Swiss National Bank has a modest holding of Apple. You know, it's an odd lot of holding, but it's like 425
Think
shares.
about how bizarro the last 10 years have been. The fact that they were building up a portfolio of US equities to weaken the currency domestically. And you, Tom, to your point, you could take any given tech name and you could go down the holdings on the Bloomberg and you'd see the Swiss National Bank on some of them.
I'm sorry, on our way to Davos next year, we can do a remote from Brasserie Lip. I mean,
Is that
it
what you'd
just
like
makes
to?
sense.
Sure, we can do that.
There is a bigger suggestion here, though, of the asset price inflation over all of this time and this flight to quality and how the Swiss National Bank was the ultimate quality, which really suppressed inflation, created the wealth. It was just amazing flows. And they just didn't know what to do with the money, which really brings us to today. Are we going to drain that money, or is it still there, waiting to do something with it, given all of the asset price inflation?
I think in general, don't hit your mic stand. It's just.
I can't help it. I'm worrying.
She's fired up.
Sympathy mic stand.
She's fired up.
Good morning.
Oh, this is great for radio. Radio are going to love you for this.
Yes, thank you.
TV
no,
too.
I think that it's a unique experiment, but it comes to flows, and part of that will be, as you mentioned before, the inflation-disinflation dynamic with a rebounding China. That's about flows, and we haven't even talked about Japan and that unique soap opera.
Well, let's talk about
Where
Japan.
is yen?
Kuroda's got one more meeting to go on March 10th. Then he heads for the exit, and he leaves behind just a monster balance sheet, owning everything under the sun.
Yeah, it's important to me. Like, we can do our team coverage there in Tokyo on our way to the spring meetings of the IMF. But the bottom line is, at the IMF, they're going to be riveted on what the Bank of Japan does.
Could you share this diary with me? This diary you have about our schedule.
We can do it. The worst part,
I haven't seen it.
Help me in Washington. You can help me on this. I know Matt Shirley down there knows this. The worst part of Tokyo to Washington, and I've done it, is the last 30 miles from Dulles. It's the absolute worst.
Why is that?
It's just clumsy. It's JFK, you know, is a certain agony, like you're stuck in traffic.
Sure, I know.
Dulles, you're not stuck in traffic like that, but it's clumsy.
At least LaGuardia's getting it done. You know, LaGuardia's really sorted out. That airport's gone from like the worst.
Well, this is called
to one of the
infrastructure
better
investments.
Did you see those fountains that change shapes?
Yeah, I've seen people video them. I'm just like, get a life,
I don't.
get your flight.
Okay, so you don't even look at it?
No, I walk past it. You have to see it.
One of the fountains, when it changes shape, it looks like Steve Cohen.
Live from New York. I'm so pleased the clock is done. This is Bloomberg.
what do you like most about your job?
I think the people. I mean, ultimately, we're a people business. A lot of what my job is as CEO of the company is to give those people sort of motivation, to tell them where we're going, to encourage them to come up and do their best work, to encourage them to collaborate. Sometimes you sort of think you're almost a psychologist, as you are a business leader, I think, sometimes.
And so what's your best piece of advice?
I love pitches. I love being sort of leading from the front, if you like, and spending times with teams. I love to see the work that we're doing. When we pitch for a piece of new business, often when we come together. So I guess I try and put myself in the seat of the client. And what's the client going to think when they see this work? Are they going to be excited? Is it going to turn their brand around? How's it going to resonate with their consumers? So as much as possible, I think probably I try and play that role.
Why is it that whenever there is like a scare coming along or a pandemic or something, people rush to buy toilet paper? Have you ever noticed that? People are just, they're stockpiling toilet paper.
It's called a hoarding, and
okay.
It's one of those things you never want to be without.
Where did the first month of the year go? Just like that, final trading day of January. Blink of an eye, and what a rally we've seen over the last 4 weeks and change. Equity futures this morning, and good morning to you. Look a little something like this on the S&P. We're down by 0.5%. On the Nasdaq, down 0.75%. Biggest one-day loss on the Nasdaq of the year so far. Just yesterday, we add to those losses this morning. Still up, though, by around 8 to 9%. Quite a move over the last month or so. In the bond market, we started the year at about 442 on a 2-year. We came all the way back down to something like 423 very early on in the year, and then kind of stabilized over the last couple of weeks on a 2-year at 423.83 on a